Hi guys, how are you? What's up? I hope you all are doing very amazing. Welcome back to our day 1 of our marathon lectures for the subject of corporate and economic laws. People, before we begin, quickly tell me if my voice is audible and my screen is visible. Give me a quick thumbs up, guys. So people, before we begin, hi Varun, how are you? Varun, is my screen visible? Is my audio clearly audible, guys? Give me a quick thumbs up. Perfect. So people, before we begin, let me tell you what are we going to do in these marathon lectures. People, number 1, every single important topic of all the chapters of corporate and economic laws will be covered in detail. Number 2, MCQs for every single chapter will be covered in detail. Number 3, we are going to do writing practice. Writing practice for 2 types of questions. Number 1 is direct question and number 2 is case study based question. Okay, sir. Now, the language is going to be completely English language, 100% English language. So simple that even a 10-year-old would also get it. Number 2, we all know that law exam is getting difficult by every single attempt. So we need to focus more in details of the law. Number 3, while you watch my marathon lectures, if you have got any doubts, it could be a silly doubt, it could be a genius doubt, you need to ask me in the chat box. If you guys are watching these lectures after the live has ended, you need to ask me in the comment section. Number 4, the reason why 9 days marathon is because I want every single student who is watching these lectures to score at least 70 marks in corporate and economic laws. Yes, you heard it right. It's not difficult, people. If you understand the logic behind why provisions have been made, it's a cakewalk. Trust me. And last is, people, to make maximum use of these lectures, please print my notes and follow along with me. Cool, people. Hi, Tejasvi Pawar, Varshil, Vignesh. Hi, guys. Quickly tell me, from where are you guys watching these lectures from? Which part of India are you watching these lectures from? Quickly let me know in the chat box. And then, people, without wasting any time, we're going to begin with our first chapter of SEBI regulations, and that is how to raise finance from capital markets. It's going to be a lot of fun, people, trust me. Yes, I'm waiting for your replies, guys. Varun, Vignesh, Tejasvi Pawar, Karnataka, Chennai. Wow. Vignesh is watching from office. Okay. Tejasvi Pawar, yes, I know you're watching from Pune. Perfect, people. So shall we begin? Give me a quick thumbs up and let's get started with our first chapter, and that is raising finance from capital markets. People, first tell me, what is the meaning of IPO? IPO is nothing but issuing shares to the public for the first time is called as IPO. First time is called as IPO. Now that company has gone for an IPO, now after a certain period of time, they want to again raise finance. So they will go for an FPO. Subsequently, when the company issues shares to the public, this is called as FPO. A further public offer is when a company issues shares to the public after an IPO. 2 things, very easy, IPO and FPO. IPO is first time, after IPO is what we call it as FPO. Next, people, offer for sale, very important concept. So a company can go for an IPO in 2 ways. Either you issue new shares to the public or you sell them the existing shares. We'll tell you with a beautiful example. Be with me, guys, be with me. Yes. So people, 2 ways. Number 1 is you issue new shares to the public or you sell existing shares. Now let's understand this using an example. People, let's say, take an example of Reliance. Okay. So Reliance have got three types of shareholders. Number one is people Mukesh Ambani. Number two is Anand Ambani. And number three is Bill Gates. Mukesh Ambani is holding 30 shares. Okay, sir. Anand Ambani is holding 60 shares. Okay, sir. Bill Gates is holding 10 shares. Now people, Mukesh Ambani does not want to issue new shares. Why? Because Bill Gates wants to exit the company. So what Mukesh Ambani tells Bill Gates is that, Bill Gates, instead of issuing new shares to the public, why don't you sell your shares to the public? You want an exit. We want our shares to be with the public. So you sell your shares to the public. Public will get the shares. Bill Gates will get an exit. And our shares will be listed in an IPO. This is called as people offer for sale, where existing shares are given to the public. Very easy, no people? Okay. Now let's come over here. Types of IPO we know. Now the important question is, how does this IPO works? Who all will help the company in going for an IPO? Number one is people, issuer. Obviously the company that is going for an IPO, we call them as issuer. Example is Zomato, which is going for an IPO to expand. Okay, sir. Next is shares will be issued to the public. Now we want the shares to be converted into electronic form. Now the important question is, who is going to convert our physical shares into electronic form? Over here we call them as a depository. So there are two depositories in India, NSDL and CDSL. Their job is to convert physical shares into electronic format. Okay, sir. Now people, we know who is going to convert physical shares into electronic format. Now the more important question is, from where are we going to buy and sell shares? We're going to buy and sell shares from the market. We call them as NSE and BSE. You know this. Okay, sir. Now, once investors purchase the shares, where are they going to store these shares? They're going to store these shares in a digital locker. We will call them as demat account. Very easy, no people? Okay. Hello, Samiksha. Hello, Vignesh. Vignesh is filing GSTR. Watching from Surat, Gujarat. Sir, Companies Act is a little tough because KSD made so if possible also. Yes, Varshil, don't worry. I told you, my goal is every single student who is watching these lectures, my goal is to cover everything that will make you score 70 plus marks. Okay, sir. Chalo. Now, people, next topic. Eligibility of the issuer. When can a company even think about an IPO? When can a company think about an IPO? So people, there are how many conditions are there? 10 conditions are there. We'll go them one by one. A lot of students have told me, sir, please refer mind maps while you take the revision. So let's go towards the mind map. So people, how many conditions are there? 10 conditions are there. Now what we're going to do is, we're going to classify all these conditions. Let's talk about red points first. Red points talks about default conditions. So people, issuer, company, company's promoter, director or selling shareholder should not be debarred by SEBI from accessing the capital markets. Also, you should not even be involved with people who have been stopped from accessing the capital markets. Number one condition is very easy. Issuer, promoter, director, selling shareholder should not be debarred by SEBI. At the same time, they should not even be involved or be friends with people who have been debarred from accessing the capital markets. Okay, sir. Now, next is red point. Promoter, issuer, director should not be a willful defaulter. It should not be a case wherein you have taken a loan and you have defaulted in the repayment of loan. So, two conditions with respect to default is done. That is red condition. Okay, sir. Now, we'll talk about very, very easy conditions, basic conditions. Green points talks about very easy conditions. Obviously, people, if you are going for an IPO, you have to take the approval of the stock exchange. Yes or no, people? So, approval from stock exchange, wherein at least one stock exchange you have to appoint as the Designated stock exchange. Sir, what is the meaning of designated stock exchange? This is a stock exchange that will mainly coordinate your activities. It could be NSE, it could be BSE. Okay, sir. So, among the easy conditions, number one easy condition is you have to take the approval from the stock exchange. Number two is people, agreement with the depository. Your shares are going to get converted into electronic format. Don't you think you have to enter into an agreement with the depository? Okay, sir. Next is no partly paid up shares. That means what? Before the company goes for an IPO, there should not be any partly paid up shares. If there are any partly paid up shares, you have got two options. Number one, either you convert partly paid up shares into fully paid up shares, or you simply cancel those shares. Okay, sir. Now, three very basic conditions are done. Now, one more basic condition is IPO offer period should be between 3 days to 10 days. So, four easy conditions are done. Two conditions with respect to default is done. Now, we are going to talk about three difficult conditions. Be with me. The number one difficult condition is people, minimum 90% subscription should be there. If a company is going for an IPO for 100 crores, at least 90 crores subscription should be received by the company. Otherwise, the entire money shall be refunded. Okay, sir. Now, next is minimum 25% limit in general corporate purposes. People, tell me one thing. If a company is raising thousands of crores of money, don't you think they should use it towards big activities like expansion, diversification, acquisition? But if the company is using this much amount of IPO money towards basic daily activities like general corporate purposes, don't you think it doesn't make sense? So people, what the law says is that you take money from the public, we don't have any problem, but use that money wisely towards bigger goals you have to use. You cannot use all that money towards general basic corporate purposes. Yes or no, people? So maximum 25% limit, you can use it towards general corporate purposes, not more than that. If company has raised 100 crores of money, maximum 25 crores only you can use it for general corporate purposes, not more than that. 75 crores should be utilized towards big goals. Easy, no, people? Chalo. Now let's talk about the most difficult condition where you will often find it difficult to understand. And that is, where is it? Yes, this one. 75% of project finance. Sir, what is the meaning of project finance? Let's come over here. Example. People, let's say Zomato is planning for an IPO of 100 crores wherein they want to use this money to purchase 1000 new delivery vehicles. This is called as project finance. Total money they want. Okay. Now, among these project finance people, 10 crores are already there in their bank account. We will call them as internal accruals. Okay, sir. Now, they are going for an IPO for only 30 crores. The remaining money, they have got a backup or they're going to take a loan from the bank. So, 10 crores they're going to get it from their bank account. 30 crores they're going to go for an IPO. 60 crores they're going to take using loan and a firm investment backup. One investor is saying that, don't worry, we will give you this much amount of money. Now people, what the law is trying to say is, at least you should have 75% of firm backup commitment, excluding bank account, excluding IPO proceeds. That means what? 75% of 60 crores. That means 45 crores money you should have a firm backup. Do you know why this law has been made? So that company does not completely dependent on IPO. They should also have other sources of money. Okay. So let's come over here. Rule. So 75% of project finance. Project finance means total amount of money they want, excluding two items: internal accruals, IPO proceeds. 75% of project finance, you minus IPO proceeds, you minus internal accruals, balance 60%. 75% you should have a firm backup. This is the most important part where you will often get confused. The goal is company should not be completely dependent on the IPO. Very easy, no, people. give me a quick thumbs up, guys, if you're watching these lectures and you are understanding every single thing that I'm teaching you. Hello, Samiksha. Hi, Aro. I'm doing great, Aro. Chalo. Give me a quick thumbs up, guys, everyone. So we are done with eligibility conditions for a company to go for an IPO. So 10 points we are done. Now people, we are going to come to the most important part of the chapter, and that is when can a company go for an IPO. Before that, we understood when can a company even think about an IPO. Basic conditions. CMA foundation. This is going to be your CMA final. So once you comply with the basic conditions, now you have to comply with the main conditions. Now let's look at the main conditions. Chalo. We'll use the mind maps. Main conditions. People, this is the heart of the chapter, so please be with me, okay? Very important. If you don't understand anything, quickly let me know in the chat box, okay? Chalo. The first condition is company should have net tangible assets of at least 3 crores in each of the last 3 preceding financial year. Net tangible assets means, plant, machinery, land, building. Now people, among these net tangible assets, we know at least 3 crores they should have in each of the last 3 preceding financial year. Now people, among these net tangible assets, less than 50% of the net tangible assets should be in monetary form. Now people, the logic behind why this law has been made is because if company has got more than 50% in monetary form, then people, don't you think company has got already huge amount of money? Why are they even going for an IPO? That means they don't know how to use that money. So SEBI says that you should have net tangible assets of at least 3 crores in last 3 preceding financial year. But among those net tangible assets, less than 50% shall be held in monetary form. Now, if at all you have got more than 50% in monetary form, no problem. It's just that you have to give a firm commitment to SEBI as to how are you going to use this much amount of extra money. So first condition is very easy. Now people, this 50% rule is not applicable if the company is going for offer for sale. The logic is simple. Company is issuing existing shares, not new shares. So no monetary benefit has been created. That's why this law is exempt if the company is going for offer for sale. Very easy, no people. Yes, Jayanand. These lectures will be there in YouTube, guys. Don't worry. I know that you have got internships, you have got a lot of responsibilities. So don't worry. These lectures will be there in YouTube. But please make sure to watch all those lectures and take notes. The goal is to get you 70 plus marks in corporate and economic laws. Okay, sir. Chalo. First rule is very easy. Net tangible assets at least 3 crores in each of the last 3 preceding financial year. Less than 50% shall be held in monetary form. If at all the company has got more, company shall give a firm commitment to SEBI as to how are they going to use that money. Now this 50% rule is not applicable if the company is going for offer for sale. Easy, no? Chalo. Now number 2, minimum pre-tax average operating profit. What is the meaning of operating profit? Profit that has been earned using the operations. Pre-tax means what? Before tax operating profit. Now over here people, average word has been used. So what you have to do is, you have to first find out last 5 financial years operating profit. Last 5 financial years operating profit. Now among those last 5 financial years, you need to take the best 3 out of last 5 financial years operating profit. Once you have taken 3 years operating profit, you have to take the average. The average should be at least 15 crores. Now people, let's understand this using example. See, minimum pre-tax average operating profit of last 5 years, 8 crores, 18 crores, 22 crores, 10 crores and 20 crores. Now you have to pick the best 3 years. 22 crores, 20 crores, 18 crores. You have to take the average, that is 20 crores. That means company has complied with the minimum pre-tax average operating profit of 15 crores. Very easy, no people? Are you able to understand? Give me a quick thumbs up, guys. So 2 conditions are done. Now one more thing, listen to me very carefully. Over here, Restated and consolidated basis word has been used. What is the meaning of restated basis, people? Restated basis means what? There should not be any valuation errors, there should not be any defects in the valuation. That is called as restated basis. What is the meaning of consolidated basis? If holding company is going for an IPO, subsidiary company's financial results shall also be taken into consideration. If holding company is going for an IPO, subsidiary company's financial results shall also be taken into consideration. That is called as consolidated basis. Are you with me, guys? Yes. Perfect. Now, people, two conditions are done. The third condition is very easy. Company should have net worth of at least 1 crore in last 3 preceding financial year. Okay, sir. Now, the fourth condition is very interesting. This is my favorite. What this condition says is that if the company has changed its name from, let's take an example, Box Televisions Limited to AI Televisions Limited. If the company has changed its name in the last 12 months, more than 50% of revenue shall be earned using the new name in the preceding financial year, so that whoever is going to invest will invest thinking in mind that the company is into AI televisions and not box televisions. Are you able to understand, people? So 4 conditions, quickly tell me. Number 1 is net tangible assets, at least 3 crores in each of the last 3 preceding financial year. Less than 50% shall be held in monetary form. If at all the company has got more than 50% held in monetary form, company has to give a firm commitment to SEBI as to how are they going to use that money. Now this 50% condition is not applicable if the company is going for offer for sale. Next is minimum average operating profit shall be 15 crores. Now you have to take the best 3 out of last 5 financial years, take the average. Whatever value you will arrive at, it should be based on restated, no defects, consolidated. Subsidiary companies' financial results shall also be taken into consideration. Next is net worth shall be at least 1 crore in each of the last 3 preceding financial year. And next is if the company has changed its name in the last preceding financial year, more than 50% of revenue shall be earned using the new name. Very easy, people. Are you able to understand, people? Give me a quick thumbs up, guys. Now what we are going to do is, I'm going to tell you one roller coaster rule. Now you will be shocked when you listen to this rule. Even if company does not follow all these 4 rules, still the company can go for an IPO. Sir, how is this possible? Now, listen to me very, very carefully. Even if company does not follow all these 4 conditions, company can still go for an IPO, provided they allot 75% of net offer to not individual people like you and me, to big people like mutual funds, banks, insurance companies, using a book building mechanism. Now, what is the meaning of book building mechanism? Book building mechanism is selling all the shares at maximum price is called as book building mechanism. Over here, price is discovered using the amount of demand by the investors. Okay, we are going to come over to that later. But simply understand that if the company does not follow all the 4 conditions, company can still go for an IPO, provided 75% of net offer is given to QIB, big people, and the price shall be discovered using the book building mechanism. Now, people, if the company still fails to follow this condition, company has to refund all the money back within 4 days. Very easy, people. Now, the reason why this rule has been made is because even if company does not follow all these 4 conditions, still, people, there would be 1% of company that has got a lot of potential. They deserve to go for an IPO. Now, these big people, mutual funds, banks, insurance companies, they have got huge amount of money. They have got a huge amount of data. So, using that data, if they believe that this company has got a potential, company shall go for an IPO. Nobody can stop that company to go for an IPO. Easy, no, people? Give me a quick thumbs up. Hello, Siddesh. Yes. That's it, people. Now let's come to the next topic. So now you know the heart of the chapter. Now you are by heart. When can a company go for an IPO? Okay, sir. Now next is, people, other conditions during an IPO. So if the company is going for an IPO, during the IPO also company has to follow certain rules and conditions. What are those rules and conditions? We are going to understand. Okay, sir. Chalo. Now, other conditions. People will start with the very basic condition, easy condition. Minimum number of allottees should be more than 1000. Minimum number of allottees should be more than 1000. This is the basic condition. Okay, sir. Now, next is, this is slightly difficult, but the logic is beautiful. Convertible debt instruments. Company can issue convertible debt instruments. I'm not talking about debt instruments. I'm talking about convertible debt instruments. What is the meaning of convertible debt instruments, people? Debt instruments that can be later converted into equity shares. So company can list convertible debt instruments first, even if they don't issue equity shares before. But there is a rule that says that company should not have defaulted in the principal or the interest in the last 6 months. So basically the law says company can issue convertible debt instruments, but they have to ensure that there is no default in principal or interest in the last 6 months. Okay, sir. Now, this is the most beautiful condition that you will ever come across in this chapter, that says that company shall not have any outstanding convertible securities during an IPO. That means what? The company is issuing equity shares. You have to check before they should not have issued any convertible debt securities, which could be later converted into equity shares. Do you know logic, people? The logic is simple. If I issue equity shares right now, but before I've already issued somebody convertible debt instruments, now the moment these people will convert their debt instruments into equity shares, don't you think the supply of equity shares will suddenly increase after the IPO? Now you tell me, people, if the supply of any commodity increases, the price will decrease. That means what? You have suffered a loss just because this guy has converted his debt securities into equity shares. You are suffering a loss. This should not happen. That is why SEBI says company shall not have any convertible outstanding securities. Now it could be warrants, it could be convertible debentures, it could be convertible bonds, or any rights that entitle the holder to receive equity shares after the IPO. Very easy, people. Okay, sir. Now next is IPO grading. IPO grading is simple, nothing but a report card of the IPO. Now if people, let's take an example of Bailey. Okay. Now I don't know if Bailey is going for an IPO. I don't know the potential of Bailey. So over there, people, credit rating agency, one or more, they will issue a report card of this IPO. Now they will tell whether the company is using this money wisely or not, whether investors shall invest in this company or not. All the details will be given by the credit rating agency. This is called as IPO grading, so that no investor shall be fooled and investors can make informed and right decisions. Okay, sir. Now comes the last rule that says that if the IPO proceeds is more than 100 crores, that means a very huge amount. Now there is a chances of misuse of this money. So SEBI says that if your IPO size is more than 100 crores, you need to appoint a bank or a private financial institution. For what purpose? To monitor how the company is using that money and to report on a quarterly basis until 100% of the money has been utilized. All the rules, if you people observe, all the rules are made only to achieve one objective in mind: to save investors money. Easy, no, people? Are you with me? Give me a quick thumbs up, guys. Quickly give me a thumbs up if you are with me. And let me know if my speed is comfortable. Am I too fast? Am I too slow? Just let me know in the chat box. Yes, guys? Okay. Yes, people, are you with me? Now people, we're going to talk about the another important topic, and that is intermediaries. Okay, let's talk about the intermediaries. That means what people, now you tell me, if Zomato is going for an IPO, Zomato has already got so much amount of work pending with respect to business. They don't have time to manage this IPO. So over there, Zomato will appoint a guy called as merchant banker. Now the job of a merchant banker is to guide the entire IPO process. He coordinates with all the intermediaries so that the company goes for an IPO successfully. This guy prepares legal and financial documents. Okay, sir. Next is, this guy will also decide the price of the shares. So everything with respect to IPO is managed by the merchant banker. Now this merchant banker may also appoint other merchant bankers. Why, sir? Because people, a lot of times IPO size is very huge. It is not possible for one merchant banker to handle the entire IPO. So merchant banker can also appoint another merchant bankers, whereas one guy will act as a lead merchant banker. Okay, sir. Now next intermediary is registrar. Now what is the role of registrar, people? This guy will accept the applications and ensure that right number of shares are allocated to the investors, and in case company is refunding shares, this guy will make sure the refund process is properly taken care of. And next is, he ensures allocation of shares. Very easy, people. And in case the shares are oversubscribed, this guy will refund the shares. Basically, he is going to be the administrative manager of the IPO. Okay. Now next is people, underwriter. Now people, underwriter's job is amazing. So underwriters are basically guarantee providers. In case the company does not able to raise 100% amount of money, this underwriter guarantees the company that don't worry, buddy. If you're not able to raise 100% money, don't worry, we will purchase a leftover shares that has not been sold to the public. Don't worry, even if you're not able to raise 100% of money from the IPO, don't worry, we will purchase the leftover shares in the IPO. Basically, underwriter's job is to make sure 100% money has been raised in the IPO. Okay, sir. Guarantee providers in the IPO, they promise to buy leftover share that has not been sold in the market. Next is people, bankers to the issue. Their job is very simple. To accept money from the public, once IPO is done, send this money back to the company for which they have raised the money. Very easy. Responsible for receiving money from investors who want to buy shares in the IPO. Once IPO is done, money gets transferred back to the company. Easy now, people. Are you guys with me? Yes, I will share the mind map. Don't worry, guys. Then people, next is syndicate member. Now people, do you remember I told you right now, book building mechanism. So company has got two ways to find out the price for a shares. It could be fixed price mechanism, and number two is people, book building mechanism. Now what is the meaning of book building mechanism? Book building mechanism is nothing but selling all the shares at maximum value is called as book building mechanism. For that you have to find out the demand of the shares. So all this work of book building mechanism will be done by the syndicate member. Helps in distributing shares, help in the book building mechanism, and next is helps in the coordination so that IPO runs smoothly. Basically, this is the helping guy. Mainly, he will have his role in book building mechanism. Next is people, compliance officer. So whatever rules and regulations we are studying, compliance officer job is to check if the company is following all the rules and regulations or not. Monitor compliance with the security laws, and next is addresses all the investor complaints. So people, 1, 2, 3, 4, 5, 6. 6 intermediaries we have understood. Number 1 is the merchant banker, main guide of the IPO process. Number 2 is registrar. Everything with respect to shares will be managed by the registrar. Underwriter, shares that has not been sold in the market will be purchased by whom? Underwriter. Next is banker to the issue. Everything with respect to money will be managed by banker to the issue. Compliance officer. Everything with respect to rules will be supervised by the compliance officer. And last is syndicate member. this guy will come into the picture when the company is using book building mechanism. Yes, people, are you guys with me? Give me a quick thumbs up. You can be bit fast, sir. Varun. Okay. Yes, guys. Quickly give me a thumbs up if you guys are with me. I want to know whether you guys are watching properly or not. Give me a quick thumbs up, guys. Everyone who is watching right now. Amazing, amazing. Chalo. Now comes the most important topic, and that is, people, promoters' contribution. People, definitely, if I would be the examiner, I would put this question in your exam. Definitely, promoters' contribution. Very, very important topic. So people, promoters' contribution is minimum. Promoters' contribution should be 20% of post-issue capital. That means what, people? Let's come over here. If company's total share capital after IPO is 100 crores, wherein 100 shares have been issued, at least promoters shall contribute 20 shares. Promoters must hold at least 20 shares. Company has got total 100 shares. Promoter must purchase 20 shares. I will tell you why. Now people will tell me one thing. Company is raising huge amount of money, thousands of crores, lakhs of crores. Company is using this money anyway. They are not responsible in utilizing their money. Don't you think, people, if that is the case, promoters' money should also be locked in? Otherwise, promoter will not do anything. The company will misuse the fund of the public. That is why SEBI says that you have to stay invested in this company. If you misuse the fund of the public money, your money will also be misused. So, SEBI says minimum 20% of post-issue capital must be invested by the promoters. Okay, sir. Now, people, lock-in period over here, amendment has come into the picture. You don't have to study the old laws. I will just study the new laws. Just understand new laws and keep in mind. So, people, two situations are there. Number one situation is company has raised 1000 crores. Now, two options are there with the company. Either to use that money towards capital project, big project where the return will take a lot of time, or company can use it towards non-capital projects, safe short-term purposes. Now people, if company is using that money towards big capital project wherein more than 50% of IPO money has been used towards capital projects like setting up of plant, machinery, building, acquiring another company, in that case, people, 20% of promoters' money will be locked in for a period of 3 years. So whatever money has been contributed by the promoter shall be locked in for a period of how many years? 3 years. If at all you are investing more than 50% of IPO money towards capital projects. Easy enough, people, because capital projects takes a lot of time to give returns. So promoters' money should also be locked in for a period of a lot of time. That is the logic why this law has been made. The next situation is, people, no big capital project. Company is using less than 50% of money towards capital projects. Very less money towards capital projects. In that case, people, return will be very, very fast. So, SEBI says promoters' money will be locked in for a period of 18 months or 1.5 years. So, if it is more than 50% of money towards capital projects, 3 years. If less than 50% of money is towards capital projects, it is 18 months or 1.5 years. Are you able to understand using the logic, people? Very easy, no? Chalo. Now, people, the important question is, from which date this 1.5 years, 18 months or 3 years will actually begin? This date will begin from the commencement of commercial production. That means what? Commercial production means what? The purpose for which company has raised the money. If company starts that business operation, that is called as commencement of commercial production, or the date of allotment of shares in the public. Whichever is the later date will be taken into consideration as the start date be it 18 months or be it 3 years. Easy now, people. Are you guys with me? Give me a quick thumbs up. Sir, notes where we can get. Guys, in the description you will find one WhatsApp group. In that WhatsApp group you will get all the notes. Okay, don't worry. Now, even after this marathon has ended, I will send you all the notes, so you don't have to worry. Okay, sir. Chalo. Now, people, by mistakenly, promoter has contributed 25%. He should be contributing 20%, but he has contributed more. In that case, people, the excess contribution shall be locked in for a period of only 6 months, not more than that. Easy no? Basic law says 20% of money shall be locked in. If it is capital, 3 years lock-in. If it is non-capital, 18 months. The date will start from commercial production or allotment of public, whichever is a later date. And in case promoter has contributed excess money, only 6 months will be lock-in only for the excess money. Okay. Now, people, if we talk about the FPO, further public offer, there is no lock-in period. Why? Lock-in period is only applicable in IPO because public is trusting the company for the first time. Company is going for an IPO for the first time. So, matter is very, very sensitive. In that case, SEBI says lock-in period is applicable. Now that company has gone for an IPO, now company is going for an FPO. Now everybody trusts the company. In that case, lock-in period is not applicable. Easy now, people. Are you able to understand this using the logic? $1.5 or 1 year? 1.5 years, Bamit. See, 18 months or 1.5 years if it is non-capital projects. If it is capital projects, it is 3 years. Varun, I am talking about purely from the IPO where the shares are listed. Okay, we are not talking about unlisted company at all. So people, now let's move on to the next topic, and that is allocation of shares in the IPO. Before we dive into the allocation of shares in the IPO, understand this one thing: there are 3 types of investors. Number 1 is people, retail individual investors, people like you and me. Small investors who apply for shares up to maximum 2 lakh rupees. They invest using their personal money. There is no backup. Example is salary people, college student. So people like you and me are retail individual investors. Next is people, non-institutional investors. They are big, wealthy individuals, not companies. High net worth individuals like Mukesh Ambani, Bill Gates. They are all high net worth individuals, or we can call them as non-institutional investors who invest more than 2 lakh rupees, and they are not institutional investors. They are not banks. They are not insurance companies. They are not pension funds. Number 3 is people, qualified institutional buyers. These are very big people, huge companies, mutual funds, pension funds, insurance companies. So 3 category of investors. Number 1 is people, tell me quickly, retail individual investors. Number 2 is non-institutional investors, and number 3 is qualified institutional buyers. Now let's come over here. This table. So people, if I talk about, let's come over non-book building mechanism, where price is discovered using fixed price mechanism. When the company is going for an IPO, price has been fixed. We are not using book building mechanism at all. So in that case, people, at least 50% of shares shall be allocated to retail individual investors, and the remaining shares can be adjusted anyhow between non-institutional investors and qualified institutional buyers. Okay, sir. Now, book building mechanism. It's a general book building mechanism. There is no excessive demand. It's a normal book building mechanism where demand is very normal from the QIBs. In that case, how will the shares be allocated? If I talk about the retail individual investors, at least 35% of shares shall be allocated to retail individual investors. Okay, sir. At least 15% of shares shall be allocated to non-institutional investors. Okay, sir. Over here, people, I use the word at least, but over here I'm using the word maximum. Maximum 50% of shares shall be given to qualified institutional buyers. Are you guys with me? Yes, no, people. Very easy. Chalo. Now next is special case. Now people, if there is a huge demand from banks, insurance companies, pension funds, mutual funds, now don't you think people, if you would be company, you would give all your shares to these big people, because these big people will not change your investment decisions based on their emotions. So obviously you will give all your shares to big people. So if there is a huge demand from the big people, in that case, I am using the word maximum 10% shall be given to retail people, maximum 15% shall be given to non-institutional investors, and at least 75% shall be given to qualified institutional buyers. Okay people, now let's come over here. There is one concept called as people anchor investors. Now what is the meaning of anchor investors? Now people, supposing if I want to gain the trust of all the people, that means what, I should at least gain the trust of one very big person. If one very big person invest in the company, everyone will follow. So people, what I will do is, I will find out one very big person called as an anchor investor. I will allocate him shares before the IPO, so that an initial demand will be created. Now these category of investors are called as people anchor investors. They also belong to the QIB. Okay. So if I am going for an IPO, I will choose HDFC Bank as the anchor investor. I will convince them anyhow that you please take my shares before the company goes for an IPO, because if you take my shares, everyone will follow you. So people, what I will do is, I have the option, I'm not saying mandatory, I have the option to allocate 60% of QIB portion to the anchor investors. Next is people, at least 5% of QIB must, I'm using the word must, not may, must go to mutual funds. So people, QIB portion I'm talking about specifically, 5% of the QIB must go to mutual funds, 60% of QIB can go to anchor investors. Yes guys, are you with me? So we are done with the chapter of how to raise finance from the capital markets. Now people, I want you to answer me all the MCQs. Let's get started. Are you guys with me? There is one small correction in the first question people. Just make that correction and then we are sorted. Everyone, give me a quick thumbs up guys. Let's start with the MCQs. Yes, Suman, don't worry buddy, I will send you all the notes. Varun, Bamit, Belgam, Tejasvi Pawar, Associate, MD Shaha, everyone, Jayanand, everyone give me a thumbs up quickly. Yes, shall we start with the MCQ guys? Chalo. The first question is the most difficult question. Over here, you will slip. Let's see. A company requires 120 crores. Company's project finance is 120 crores. So over here, just write down in my notes people, project finance is 120 crores. 40 crores is internal accruals, means bank account. Internal accruals is 40 crores. 30 crores is from IPO. 30 crores is from IPO. Now you tell me, what is the minimum external arrangement required under SEBI rule? First, what will you do? First, you will find out the project finance. Everyone take out your calculator guys. First, yes, MD Shaha, amazing. So what you are going to do is, first you are going to take the project finance, you minus two items, internal accruals and IPO, whatever money is remaining. So take 75% of that money, and that is the minimum external arrangement. Every Hello. Guys, am I audible? Am I audible right now? Guys, quickly give me a thumbs up. Yes, everyone is saying 37.5 crores. Amazing, guys. Superb. The second question. A company raises 240 crores through IPO. Maximum allowed for general corporate purpose is. You tell me, guys, what is the answer? Let's calculate. Yes, tell me. A company raises 240 crores through IPO. Maximum allowed for general corporate purpose is what? Is it 48 crores? Is it 50 crores? Is it 60 crores? Or is it 72 crores? Yes, 60 crores is the answer. Amazing, guys. Next is, if IPO subscription reaches 88% of the issue size, what will be the consequence? If IPO subscription reaches 88 crores, 88% of the issue size, what is the consequences? Partial allotment, balance underwritten, entire money refunded, listing allowed with and conditions. Yes, Varun, 25%. Entire money will be refunded. Amazing, guys. Okay. Next is, which situation? Guys, I hope that you are not reading my notes and telling me the answer. Guys, please don't refer my notes and tell me the answer. Be very honest, okay? I'm assuming that you're not referring my notes. Which situation allows IPO despite failure of financial eligibility conditions? Answer is, guys, what you do is, you give me the question number and then you give me the answer. Give me the question number and then give me the answer. Which situation allows IPO despite failure of financial eligibility conditions? Answer is C, book building with 75% QIB allotment. Remember, people, even if the company does not follow all these 4 conditions, still the company can go for an IPO provided they gain the trust of the QIBs. Okay, sir. Next is, a company has got monetary assets of 65% of total assets. When is the IPO still allowed? Remember, people, first condition, net tangible assets. Company has got monetary assets of 65% of the total assets. When is the IPO still allowed? What is the answer to the 5th question? If approved by a stock exchange, if access is committed for business use, if profits exceed 15 crores, or if QIB participation is high. Answer is B. Amazing. People, do you remember, if the company has got more than 50% of assets in monetary form, they have to give a firm commitment to SEBI as to how are they going to use that money. Okay. Next is 6th question. A company changed its name in the last year. Revenue from new activities 48%. What is the consequence? Are they eligible for an IPO, people? Tell me, what is the limit? Is it 48%, 30%, 50%? What is the limit? Tell me quickly. Yes. Balgam, Tejasvi Pawar, MD Shah. Guys, you guys are amazing. Everyone is giving me the right answer. 6th answer is C. Yes, 50% limit. Perfect. Now comes 7th question. IPO size is 150 crores. Monitoring of proceeds is required. Is it required in this case? IPO size is just 150 crores. Do we require monitoring of these proceeds? 7th question. 7th question. If the issue size exceeds 100 crores, amazing, guys, amazing. 8th question. Now, people, this is tricky. In book building, price band is between 200 rupees to 400 rupees. Sorry, 240 rupees. Highest demand is at 220 rupees. Final price will be. Now, this is where we use book building mechanism. In book building, price band is between 200 rupees to 240 rupees. Highest demand is at 220 rupees. Now, what will be the final price? Tell me, guys. 8th answer. Now I told you what is the meaning of book building mechanism, where you sell all the shares at maximum price, not fixed price, maximum price. Yes. Guys, see, highest demand is at 220 rupees. So if the highest demand is 220 rupees, everyone is going to purchase at 220 rupees, then why would you allocate shares at 240 rupees? If you allocate shares at 240 rupees, nobody is going to buy. But you know that everyone will definitely buy at 220 rupees. Yes. So answer people 220 rupees. Okay. Now, ninth question. People, are you able to understand the concept of book building mechanism? I will give you the price range. But people, in that price range, investors shall buy the shares, right? If investors are not buying shares within the price range, there is no use of the price range. So I have given the price range between 200 rupees to 240 rupees. But majority of people are willing to purchase at 220 rupees. So in that case, people, 220 rupees is the right answer. That is called as book building mechanism. Okay, chalo. Now people, ninth question is, employees in book building issue gets a discount. Floor price is 300 rupees. Minimum allowed price is. So people, I have told you. One second. Where is the topic? Yes, people. This topic is remaining differential pricing in IPO. That means what? We can offer shares at different prices in the IPO. Retail people like you and me and the employees can be given a discount of 10%. Anchor investors can never be given a discount, and employees in book building mechanism. Now people, now that we are talking about book building mechanism alternate method, I will tell you there are two types of book building mechanism. Number one is where this book building mechanism is open to the public. Everyone who is going to submit the bid will give them at maximum price shares. Now, if book building mechanism is open to all, this is called as general book building mechanism. If book building mechanism is only applicable to the employees, not to the public, this is called as alternative method of book building mechanism. So shares can be given to employees at 10% of the floor price. Now you know the law. Now tell me quickly the answer to this question, people. Employees in book building mechanism can get a discount. We know this. Floor price is 300 rupees. Maximum discount is 10%. So you minus 10% from 300 rupees. The answer will be, people, 270 rupees. Floor price. Okay. I will tell you the meaning of floor price. People, if company believes that we don't know the potential of the price of these shares, we know that these shares are gold. We know that our company has got a huge potential, but somehow we are not able to find out the maximum price that will be payable by the investors. So what I will do is, I will just give the floor price. 200 rupees will be the floor price. So anyone who is going to submit the bids, they have to submit it above 200 rupees. It could be 300 rupees, it could be 500, it could be even 1000. So I will not give a price range where two numbers are included. No, I will only give one price, that is called as floor price. Because I don't know the potential of the company. I know that investors are also willing to purchase shares at 1000 rupees. That is called as, people, floor price. Now did you understand, people, 270 rupees, how we arrived? 300 rupees minus 10%, 270 rupees. Now let's come to the last question. Over here, you will slip, definitely. Promoters hold 35% of post-issue capital. Lock-in for excess 15% will be 18 months, 3 years, 6 months, or no lock-in period is applicable to the excess promoters contribution. What is the answer to the 10th question, people? Tell me quickly. Promoters contribution. Promoters hold 35% of post-issue capital, when we know that 20% is the minimum limit. Lock-in for excess 15% will be, guys, read the question very carefully. I am talking about the excess contribution. Have I spoken about capital projects, non-capital projects? No. People read the question very carefully. Excess promoters contribution. Shall we go to the mind map? Wait, I will show you the mind map. Where is it? Where is it? See people, lock-in for excess promoters contribution is see people, read this carefully. It is excess contribution is locked in for a period of 6 months. But if you are going to use the IPO proceeds towards capital projects, more than 50% of IPO proceeds are going to capital projects, lock-in period is 3 years. If less than 50% is going towards capital, lock-in period is 18 months. But always remember, excess promoters contribution is always locked in for a period of 6 months. You will not punish that guy for investing extra money. Okay. So, FPO, there is no lock-in period. Are you able to understand, guys? Give me a quick thumbs up, people. So, we are done with the MCQs. Now, we will complete case study based question. Direct question, I will teach you how to write answers in the law exam. Then people will begin with the next chapter. Everyone with me now? Am I too fast? Am I too slow? If I'm too fast, let me know, people. If I'm too slow, it's not a problem at all. You can anyway fasten the speed. Okay. Shall we begin with the case study based question, guys? Over here, you have to listen to me very, very carefully because most of the students don't know how to write answers in the law exams. How to remember percentage? Jayanant, you have to use the logic. Okay. If it is capital, the lock-in period is more. If it is non-capital, the lock-in period is less. And percentage you have to learn, guys. Okay. If you want help, I will teach you one thing. Wait a second. Percentages. See people. 15%, 15%, same. Only over here at least word is used. Over here maximum word has been used. 15%, 15% is same. 35%, 10% you have to remember. 50%, 75% you have to remember. Okay. So you have to put in little efforts, guys, to learn because SEBI regulations will be coming in an exam for 10 marks. So we need to by heart with the percentages. Okay, na guys? Chalo. Now let's move on to the case study based question. Listen to me very, very carefully, people. ABC Limited launched an IPO, after which the promoters holding became 25% of the post-issue capital. That means what? 5% is the excess promoters contribution. Lock-in period is 6 months. The company used 60% of IPO proceeds for setting up a manufacturing plant. It's a capital project where more than 50% of money is used towards capital. So we know for the IPO proceeds, the lock-in period is 3 years. The date of allotment was 1st January 25 and commercial production commenced on 1st July 25. We know the later date will be taken into consideration to find out the lock-in period. 1st July will be taken into consideration. After a few months, the promoters decided to sell a portion of their shares. Now we know excess money can be withdrawn after 6 months, but main money have to be stayed invested for 3 years because more than 50% has been used towards capital. Question: examine whether the promoters can sell their shares considering the rules with respect to promoters minimum contribution and lock-in period. So people always remember, whenever you write answers to the case study based question, always write your answer, always start your answer from as per the provisions of SEBI regulations. Always write the answer like this. Students directly start from here. No. You have to write from where are you referring the laws. Okay. As per the provisions of SEBI regulations, promoters are required to maintain a minimum promoters contribution which are subject to a lock-in period. This is the introduction you have to write. Always, as per the provisions of XYZ regulation, introductory sentence, one sentence. Now you have to write down the provisions, what exactly the law is telling you. Promoters must hold at least 20% of post-issue capital as minimum contribution, 50% if it is used towards capital. Lock-in is 3 years. The lock-in period starts from the later date of commencement of production or later of allotment. Any excess holding about 20% is locked in for a period of 6 months from allotment. This is the provision. Provision you have to write dicto. There should not be any change in the provisions. Now people, you have written down the provisions. Now you have to write the analysis. How the provisions are connected to the case. How are you going to apply the provisions to the case? Over here you simply copy pasted the provisions what we have studied till now. But over here you're going to learn to apply these provisions. Promoters hold 25%, out of which 20% is minimum contribution, 5% is excess. We know this 5% excess is locked in for a period of 6 months from 1st January 25 and becomes free thereafter. Since 60% are used for a plant, the lock-in is 3 years. The lock-in starts from 1st July 25 being the later date. Now that you have written down the analysis, then you have to write down the conclusion in just one sentence. Hence, promoters can sell only excess 5% shares while the minimum 20% shall be locked in for a period of 3 years. Easy no people, very easy. You have to write intro, one sentence as per the provisions. You have to write down the provisions. Ditto, no change, and then you have to write the analysis. Point, numbered points you have to write, and then you have to simply write the conclusion. Are you guys with me? Give me a quick thumbs up. Jayanand is asking, can we write analysis first and then provisions? No, Jayanand. First, you have to write down the provisions. Why? Because sometimes your analysis can be wrong. There's a very quite possibility that your analysis can be wrong. So I don't want you to lose marks in the beginning itself. First, write down the provisions, same, you will receive marks, and then write down the analysis. So examiner will first notice all the good points. Okay people, this is the logic behind what I'm telling you. Intro, provision, analysis, conclusion. That's it. You don't have to complicate things. Next is people, direct question. Explain the role and functions of the merchant banker. Again, over here also you have to start with intro. As per SEBI regulation, the merchant banker manages and supervises the entire IPO process. Intro is done. Now, people, even if you don't write the provision, that's completely fine. You have to simply write down the points. Managing the IPO, preparation of documents, pricing of shares, coordination with the intermediaries, ensuring compliance, marketing the IPO. Marketing means what? Merchant banker will make sure that IPO reaches the investors. Okay. And also people, most important, underline the keywords. So whatever bold I have marked, no, they are the keywords. You have to underline those keywords. Very, very important. So that examiners 90% attention will go towards your good points. And then you have to write down the conclusion. Hence, merchant banker plays a very important role, ensuring the IPO is properly managed, compliant and successful. Easy now guys. So we are done with raising finance from IPO. So let's take a break of 7 minutes. Why 7 minutes, sir? Because 10 minutes is going to be too long and 5 minutes is going to be very short. So 7 minutes break. We'll meet at 7:16 p.m. We'll meet at 7:16 p.m. Yes, Balmsmith. For excess 5% lock-in period, date starts from 1st January. The date when promoter has contributed that money, no. From that date onwards, 6 months will begin. Okay. Now we'll take a break of 7 minutes. We'll see you at 7:16 p.m. People, are you enjoying these lectures? Give me a quick thumbs up, guys. I hope you are having huge fun. Okay, chalo. Yes, guys. Everyone, quickly come. Sir, what time limit are tested from 1st July 25? A little bit confusion. Suman, don't worry. Let's come over here. If I'm talking about the main promoter's contribution, lock-in period, 3 years, 18 months, then the later date will be taken into consideration. Commencement of commercial production, allotment of public issue. These dates, the later date will be taken into consideration when, if the main promoter's contribution are locked in 18 months or 3 years. But if promoter has contributed extra money, there's no fault of his, it's a good thing. So in that case, SEBI is little lenient. SEBI says allotment, whichever date the shares have been allotted, from that date also we can take into consideration if at all the promoter has contributed excess money. So people, simple. "18 months or 3 years. Commencement of commercial production or allotment of public issue, whichever date is the later date." Easy, no? If at all promoter has contributed excess money. Now this I'm talking about 20% money. Excess money, in that case, allotment of public issue will be taken into consideration. Simple, no people? 6 months. Easy? So now shall we begin with our next chapter, and that is insider trading. Chalo people, let's move on to the next chapter, and that is insider trading. Beautiful chapter. First tell me, what is the meaning of insider trading? One second people, I will arrange my chair accordingly. Yes. First people, tell me, what is the meaning of insider trading? That means what people, if you buy or sell shares, not a problem. But the problem is, you buy and sell shares based on the confidential information that is not known to anyone, which is unpublished information. And your goal is to gain unfair profit. This is called as insider trading. Buying or selling of shares based on confidential information which is not published, so that you can gain unfair profit. This is called as people insider trading. Very easy. Okay sir, now let's move on to the first topic. Very easy. What is the meaning of generally available information? That information which is available everywhere. Money control, then NSE, BSE, whatever information they publish, this is called as generally available information. Very easily this information is available. Information that is publicly accessible to everyone without any restrictions or favorism. Okay sir. It's available to all on a non-discriminatory basis. It's not that only few people know this information. Everyone knows this information. Once UPSI becomes public, then this information will be called as a generally available information. But only when this information has been published. If this information is not published, this is called as unpublished price sensitive information. Okay sir. Now what is the meaning of insider? Insider refers to any person who meets either of the two following conditions. Number one, he should be a connected person, plus he should possess or have access to UPSI. Two conditions needs to be satisfied. Number one could be he should be a connected person, and number two is he must possess or have access to the UPSI. Okay sir. Now what is the meaning of UPSI? So many times I'm telling you, UPSI means that information which is not available to anyone, but upon being made publicly available, it will cause drastic changes in the price of the shares of the company. This is called as UPSI. refers to any confidential information about a company or its securities that is not publicly available but could impact the price of the company's securities once it becomes public. Okay? Examples. Financial results are a part of UPSI. Dividends are a part of UPSI. Change in the capital structure is a part of UPSI. Corporate transactions are a part of UPSI. Changes in the key personnel will also be a part of UPSI. If this information is not known to anyone, only few people know this information. But they know that once this information reaches the public, it will cause fluctuations in the prices of the shares. So what these people will do is they will buy a lot of shares. Once this information reaches public will start to purchase the shares, price will go up, and during that point, these people will sell their shares. This is called as unpublished price sensitive information. Everyone, are you with me, guys? Give me a quick thumbs up, guys. Yes. Dayanand is asking basic definition of offer for sale and third point in net tangible assets contradiction. Guys, once again, let's see where were we. Third point says net worth should be at least 1 crore in the last preceding financial year. Over here, see people, what is the meaning of offer for sale when existing shares goes to the public? Now you tell me, Mukesh Ambani, Anant Ambani, Bill Gates. Did Mukesh Ambani make any money? No. So in that case, the monetary limit will not be applicable. Very easy, no, guys. Okay. Next is Jayanand. Your doubt is clear. Give me a quick thumbs up, Jayanand. Which third point are you referring, Jayanand? Net worth of at least 1 crore. Jayanand, I'm talking about this 50% rule is not applicable to offer for sale. Other conditions will be applicable, but this 50% condition will not be applicable. That says that less than 50% should be held in monetary form. Associate, you will get all these notes, guys, in the group. Don't worry, guys. Guys, what we'll do is, we'll focus completely on these marathon lectures. Okay? So what will happen is, if we go and answer the question of the notes, no, your flow will be disturbed. I don't want your flow to be disturbed. So whatever it is, I'm reading all the chat box comments. Don't worry. Every single note will reach you. Okay? That's my promise. Okay, guys, shut up. Where were we? We know the meaning of UPSI. Tell me quickly. UPSI means that information which is not publicly available, but upon being made publicly available, it will cause drastic changes in the price of the shares of the company. This is called as people UPSI. Okay, sir. Now let's talk about restrictions on communication on trading by insiders using the mind maps. Okay, let's come over here, guys. Restrictions on communication and trading by insiders. Basically, people, if you are an insider, by mistakenly you have received price sensitive information, you should not first of all trade in those shares. At the same time, you should not also communicate this information to anyone. This is your responsibility. Let's see. No insider. Insider means what, people? You tell me. Connected person, at the same time he possess or have access to UPSI. So, restrictions on communication on trading by insiders. Very, very important question. A lot of time this question has come in your exam. No insider shall communicate, procure or give access to UPSI. Exception is if it is legitimate purposes, people, you are allowed to share UPSI. Otherwise, you are not allowed to share UPSI. First point is very easy. No person or insider shall procure, give access or communicate UPSI to anyone. Okay, sir. Next is notice to insiders to maintain confidentiality. I am a listed company. I don't want my employees to trade on the basis of UPSI. To make them aware, I will give them notice that you guys are not allowed to trade on the basis of UPSI. If you do, you will be punished. So notice to insiders to maintain confidentiality. Insiders must be formally informed to keep UPSI confidential and you have to follow SEBI regulations. Okay, sir. Now, people, I told you if it is legitimate purposes, UPSI can be shared. Two purposes, legitimate. Number one is, people, now imagine whatever I'm going to tell you. Facebook is going to acquire WhatsApp. WhatsApp wants to be acquired. So if WhatsApp wants to be acquired, they have to share information with Facebook. So in that case, it is completely allowed. So if it is acquisition, you can share UPSI. Next is, Board of Directors approve sharing UPSI 2 days before the transaction. Facebook acquiring WhatsApp 2 days before board approves sharing UPSI. In that case, it is completely allowed. So two legitimate purposes. Number one is when acquisition happens, and number two is board approves sharing UPSI 2 days before the transactions. Okay. Now, people, next is structured digital database. That means what? You have to maintain a digital database that has information with respect to who has got access to UPSI, for how long this guy has got access to UPSI, what exactly is the UPSI, all the details you have to maintain in a structured digital database. For how long? For at least 8 years. But if your company is under investigation, then you have to maintain it for more than 8 years. Okay, sir. Next is no insider trading in securities while you possess UPSI. So, people, if you are the insider, you cannot trade on the basis of UPSI. If you do, you will be punished. Now, the important question is, what if you have not taken trade on the basis of UPSI? Then who is going to prove that you are what do we say, innocent? You are innocent. Who is going to prove? If you are a connected person, if you are connected to the company, then you have to prove that I am innocent. If you are not connected, then the board of directors will have to prove that you are not innocent. Because the likeliness of you having UPSI is more if you are a connected person. So you have to prove that I did not trade on the basis of UPSI. But if you are not connected to the company in any way and you are accused of trading on the basis of UPSI, board of directors will have to prove that you are the accused, you are guilty. Are you guys able to understand? Everyone, give me a quick thumbs up, guys. Associate Jayanand, guys, notes you will get in the WhatsApp group. Don't worry, guys. Okay, all the notes I will make a booklet, PDF, and you will receive all my notes. Okay, guys. Chalo. So 5 conditions. If in exam question is asked, describe what all restrictions are there on communication and trading by insiders. For 7 marks, if this question is asked, you have to write all 5 points. Number 1 is no insider shall communicate, give access or procure UPSI. Exception is legitimate purposes. You have to give notice to maintain confidentiality. And 2 legitimate purposes, acquisition and board approves sharing UPSI 2 days before the transaction. Next is you have to maintain a structured digital database for at least 8 years. And next is no insider trading in securities while you have got access to UPSI. Very easy, no, people. Give me a quick thumbs up, guys. Yes, yes, yes. Are you enjoying, guys, the lectures? Chalo. So now next is, people, trading plan. Often students get confused, sir, what is the meaning of trading plan? We are not able to understand. So people, trading plan is a pre-decided strategy. Trading plan is a pre-decided strategy for whom? For insiders. So they can trade in the securities. Sir, what are you saying? Just now we have understood that insiders cannot trade in securities, but now you are saying that they can trade by using a trading plan. Listen to me very, very carefully. Trading plan is a pre-decided strategy. You have already decided trading plan made by an insider. Now that insider could be director, employer or any other person. Now that trading strategy has been prepared to buy or sell companies' securities in a lawful and a transparent manner is the main point over here. You are an insider, you want to buy and sell shares, you are allowed by using a trading plan. Trading plan allows you to buy and sell securities in a lawful and in a transparent manner. Okay, sir. Now let's understand how does this trading process take place. You have to follow a clear and a fixed process before trading in securities. What is that process? Number one, first of all, you cannot trade immediately. You have to submit a trading plan to the compliance officer that I wish to purchase XYZ number of shares because of XYZ reasons, which is UPSI. Now, compliance officer must ensure that the trading plan follows all the rules and regulations as per SEBI regulations. Now, listen to me very, very carefully. Now, the compliance officer will make a public disclosure that this guy has submitted a trading plan who is going to buy this many amount of shares at this price because of these reasons. Now everyone knows, yes or no people? Now the UPSI is not UPSI anymore. Everyone knows. Still you cannot buy or sell shares. You have to wait for 120 days cooling period. Let everyone understand the information. Let everyone process the information. After 120 calendar days only, after being publicly approved, only then you can trade by executing a trading plan. Number one, you will submit a trading plan. Number two, trading plan will be published. Number three, 120 days you have to wait. After that, you can execute the trading plan. Interesting people, are you able to understand? Next is people, stock exchange notification. Post approval, the compliance officer informs the stock exchanges. Very easy people. That's it. Now let's come over here. Yes. People, you have to underline all the bold keywords. Very, very important. Okay. See, I've also given you an example. A company director wants to sell a portion of their shareholding, so they submit a trading plan to the compliance officer. The plan is approved and publicly disclosed on 1st January. Based on the amended rule, the director can begin trading only after 120 calendar days. That is on or after 1st May. The compliance officer then notifies the stock exchange about the trading plan, ensuring that all trades made by the director follow the disclosed plan and are free from insider trading concerns. So if you are an insider, you can still trade, you can still buy, you can still sell securities by using a trading plan. Sure guys. Are you finding it easy guys? Give me a quick thumbs up. Janan will come over there. 2 days will come over there. Don't worry. Now people, next is disclosures of trading by the insiders. So number one will be people, initial disclosure. If I am going to be the CS of Reliance, immediately on the date of appointment, I have to make a disclosure that I am holding this many amount of shares of Reliance. Directors and KFME at the time of appointment, they must disclose their shareholding in the company. Okay. Next is continual disclosure. That means what? Irrespective of whether you have bought shares or not, you have to disclose. Let's see. Any insider, including immediate relatives, if the total value of transaction exceeds 10 lakhs in a quarter, they have to make a disclosure within 2 days of the trade. Janan, are you able to understand now? 2 days. So, continual disclosure. If I am an insider or if I am the immediate relative of the insider, if I make a transaction exceeding 10 lakhs, not in a year, but in a quarter, I have to disclose this within 2 days from the trade. Okay, sir. Now, next is disclosure by connected person. Very easy point. Employees, consultant, or any person having access to UPSI. If at all they have purchased shares, they have to make disclosure to the company. Very easy, people. So, 3 points we have understood. Initial disclosure, continual disclosure, and disclosure by connected person. Initial means at the time of appointment. Continual means if I have purchased shares worth 10 lakh rupees in a quarter, if I have sold shares worth 10 lakh in a quarter, I have to make a disclosure. And all these people will also have to make a disclosure the moment they buy or sell shares. So everyone in the company knows that who might be involved in the insider trading. Okay, now people, we're going to talk about two most important topics, code of fair disclosure and next is code of conduct. Okay, chalo. Guys, first of all, give me a quick thumbs up so that I know that you are watching my lectures very carefully. Everyone, give me a quick thumbs up, guys. Everyone. Yes. Balgam, Jayanand, Bamit, TSC Pawar, Associate. Everyone, guys, give me a quick thumbs up. Okay. Chalo. Now, people, code of fair disclosure. Now from here, you have to listen to me very, very carefully. Many times question has been asked. Okay. Now code of fair disclosure. Now you will get confused between this topic and this topic, code of conduct, as well as this topic, institutional mechanism for prevention of insider trading. You will find them as all are sounding very similar, but they are not. Let's see. Code of fair disclosure answers one question. How should a company disclose price sensitive information in a fair and transparent manner? If your company has got a price sensitive information, how should you communicate that in a lawful, in a transparent manner, so everyone will be benefited in a fair manner? Nobody should have access, discriminatory access, nobody should have. How are you going to handle this? Let's understand, people. Number one, you have to make a prompt public disclosure. As soon as you are aware of UPSI, immediately you have to disclose this to the public so that people don't take advantage of UPSI. Next is fair response to queries. So you have to respond in a fair manner to everyone, analyst, media, stakeholder queries. Supposing Arnav Goswami comes, you tell him as company is going to get acquired for 10 crores. Another guy comes, YouTuber, you tell him as 20 crores. So you're not allowed to do that. You have to give equal information, correct information, right information to everyone. There should not be any discrimination in the information. Okay, sir. Next is record keeping. You have to maintain records plus transcripts of whatever meeting you have attended, wherein you have discussed about the company's sensitive matters. You have to maintain a record. Any meetings with the analyst, investor calls, public conferences, whatever information you have given to them, you have to maintain record to which person what information I have given. Okay. Next is investor relations officer. Now you don't know how to manage UPSI, so over there you're going to appoint a professional called as investor relations officer. Now he's a senior executive who is going to manage how UPSI is going to be communicated to the public. Okay, sir. Next is avoid sharing UPSI with the analyst. You are not sharing UPSI with the public, but you are only sharing UPSI with the analyst. Not allowed. So avoiding selectively sharing UPSI with the analyst or other research personnel before disclosed to the public, not allowed. You have to give everyone the same information at the same time. Yes, Suman, I'm going to come over there. Okay, 1 second. So people, 5 points. If a question is asked in the exam, code of fair disclosure, would you be able to write all the 5 points, people? Number 1 is prompt public disclosure. Number 2 is fair response to queries. Number 3 is record keeping. Number 4 is avoid sharing UPSI with the analyst. And number 5 is, people, investor relations officer. Okay, let's come over here. Continual disclosure. Okay, so what this law is saying is that if at all I have purchased 10 lakh worth of shares in a quarter, that means what? It's an unusual transactions. Immediately I have to make disclosure. Okay, immediately I have to make disclosure that I have purchased this much amount of shares. Okay, guys. Now, next is what is the meaning of trading plan? Trading plan is a pre-decided strategy. You don't want to get accused of inside trading. So, what you do is you submit a trading plan beforehand only to the compliance officer. This guy will publish this information to the stock exchange, and everyone will know what type of information you have got, on the basis of what information you are doing the trade. So everyone will have equal access. 120 days later only you can trade on the basis of UPSI. Okay, people, over here I'm talking about any insider including relatives. Over here, value 10 lakh rupees. A value has been given to you. Okay, guys, are you there with me? Give me a quick thumbs up. Now, next is, people, code of conduct. Code of conduct answers one question. How should insiders behave while possessing UPSI? How should insiders behave while in possession of UPSI? Over here, we have studied how should company disclose price sensitive information in a fair and transparent manner. Over here, disclosure word has been used, but over here, people, how should insiders actually behave word is used. Now, let's understand. Okay. Number one is, people, formulation, administration of code of conduct. Now, you tell me whose job it is to make a code of conduct so that nobody will trade on the basis of UPSI. It is the job of the MD and the CEO, responsible for ensuring adherence to the code of conduct. Number two is reporting the board. Compliance officer will report to the board who has got access to UPSI and are their relatives trading on the basis of UPSI. All this information will be given by the compliance officer to the board of directors. Next is, people, execution of pre-clearance trade. We're going to talk about pre-clearance trade over here. Let's come over here. Or what we can do is, we'll come this towards the last, so we don't spoil the flow. Okay, we'll mark this as green. Green. Okay, so two things we have understood. Formulation, administration of code of conduct by MD and CEO. Next is reporting to the board. Who will report? Compliance officer will report. Next is inside information and its usage. Now, there should be a clear process in place to identify who can have the possible access to UPSI. There should be clear process in place as to who can be allowed to be an insider. This is called as, people, insider information and its use. There should be a clear process in place as to who can be allowed to be an insider. Next is sanctions and disciplinary actions. If you are the MD and CEO, you don't want your employees to trade on the basis of UPSI. So what you will do is you will give a sanction. You will warn them. If anyone will be found dealing in insider information, you guys will be penalized. Define sanctions, violations, warnings, and legal action. You have to warn them. So people will think 100, 200 times before they even enter into an insider trading. Very easy, no, people? Okay. Next is reporting and record keeping. That means what? Designated person shall be identified. Report company annually whenever changes occur. Now, the important question is, what is the meaning of designated person? That means what, people? Designated means who can have access to UPSI. This is called as designated persons. Designated persons as well as their relatives have to report annually on the basis how many shares we have purchased, how many shares we have sold. Okay, sir. Now, next is, read this. Designated persons as well as their immediate relatives have to report to the board along with the compliance officer, identify designated persons and their relatives. So there should be, first of all, clear process in place to identify designated persons, and designated persons as well as their relatives have to report to the company on an annual basis of all their transactions. Very easy, no, people? Are you guys with me? Give me a quick thumbs up. Now, let's talk about, first of all, let's talk about the trading window. Okay. So, people, always remember, you take the example of any listed company. The moment they have got UPSI, immediately the trading window is closed for everyone. Nobody can buy and sell shares of that company. Why? So that nobody should take an unfair advantage on the basis of UPSI. The moment company has got a UPSI, the trading window is completely closed. Now let's see. Time when employees are allowed to buy and sell company shares. Now usually what happens is ABC Limited is preparing quarterly reports. Number one, employees already know the results of the quarterly reports. Employees will buy shares now. They will make unfair profit. To prevent this from happening, company closes the trading window. When these results are made public, trading window will open so that employees don't make unfair profit or gains. Now, are you able to understand, people, the trading window logic? So, employees should not make unfair profit. So, that's why trading window is closed until this information is made public. Okay. Now, let's understand what is the meaning of pre-clearance. Even when the trading window is open, big trades requires permission first. So, even if employees are allowed to trade, the moment they are going to buy a lot of shares, huge amount of shares, they have to take a pre-clearance approval from the compliance officer. Now let's read this. Trading window plus pre-clearance. When the trading window is open, information is open to public, employees will have to take permission. They have to obtain a pre-clearance approval from the compliance officer. When? Not to purchase small shares, no. When they are going to purchase a big chunk of shares, during that period they have to take a pre-clearance trade from the compliance officer. Okay, sir. Now, people, the beauty of the pre-clearance is that you have to execute it within 7 trading days. You have to execute it within 7 trading days. Now, people, if in exam question is asked, how should insiders behave while they have got access to UPSI? Would you be able to write all the answers, guys? Give me a quick thumbs up, everyone. Number 1 is formulation, administration of code of conduct. Who is responsible? CEO, MD is responsible. Number 2, designated persons and their immediate relatives must be identified to monitor their trades. Next is compliance officer will report to the board with respect to all the trading activities of the insiders, designated persons and their relatives. Next is trading window and pre-clearance. Even if the trading window is open, people will still require pre-clearance trade when they're going to purchase a big chunk of shares, and that trading window shall be executed within 7 days. Next is insider information and its use. There should be clear process mechanism in place to identify who can be allowed to be an insider. Next is record keeping of all the designated persons and their relatives. And last is to prevent insider trading, company must make everyone aware that if you trade, you will be penalized. Everyone with me now, guys? Give me a quick thumbs up. Okay. So now we know code of conduct also. 2 things we have understood. Similar topics, don't get confused. How should a company disclose? Over here, how should the insiders behave? Now, people, last topic is how to prevent insider trading. How to prevent insider trading. Number 1, people, that should be again similar topics. Internal controls by the CEO. Now, CEO is responsible to also implement the internal controls. Just by formulating is not enough. You also have to implement. Okay, sir. Next is audit committee's role is to review whether internal control system is strong or not. If it is ineffective, audit committee will suggest changes to make these internal controls more strong. Next is inquiry procedures for information leaks. If at all UPSI gets leaked, there should be a proper procedure to find out who was trading on the basis of UPSI. Investigation process must be clear. Next is, people, whistleblower policy, a beautiful concept. If I am an ordinary employee, I know that a very big senior management person was trading on the basis of UPSI. But the problem is, I cannot complain to anyone. Why? Because I am afraid that I will lose my job. So that is why, people, whistleblower mechanism has been put in place so that employees like me can complain, can bring this guy to the front that this guy traded on the basis of UPSI and nothing will happen to me. This is called as people whistleblower mechanism to encourage employees to report suspicious activities. Now next is people last. All the intermediaries, if at all an investigation is going on, all the intermediaries, everyone must cooperate during the investigations. Yes guys, Jayanan will come to that, buddy, don't worry. Now so people, all the points are very easy now, clear? Now, Jayanan's doubt, 120 days and 7 days. Jayanan, over here I'm talking about execution of pre-clearance trade. That means what? Pre-clearance means what? If the trading window is open, still you can purchase big chunk of money. Still you can purchase a big chunk of money. So you have to get an approval from the compliance officer, and whatever compliance officer has approved, you have to execute that trade within 7 days. Okay. Now this is called as execution of pre-clearance trade. When the trading window is open, still you have to take an approval. But over here people, where is it? Next question is 120 days. Over here people, you are submitting a trading plan that in the future I want to purchase this much amount of shares. In the future I want to purchase this much amount of shares. So you have to take approval from compliance officer. It will be published in the stock exchange. Everyone will know what type of UPSI you have got. So there will not be any discriminatory trading. Did you understand, buddy? Over here you are trading on the basis of UPSI. Over here trading window is open to all, but still you being an insider, if you want to purchase a large amount of money, shares, then you have to obtain a pre-clearance trade. This is less risky. That one is more risky. That is why such strict laws has been made. Okay guys, everyone with me. So now what we are going to do is we are going to solve MCQs. First of all guys, quickly give me a thumbs up. I want to know who is watching those lectures. Quickly give me a thumbs up guys. Belgam, Suman, Jayanand, Bamit, MD Shah, Tejasvi Pawar. Everyone give me a quick thumbs up guys. Perfect. So now people, let's solve MCQs. First question. Which of the following will qualify as a generally available information? Option A, option B, option C, option D guys. Quickly tell me guys. Present sir, yes. Thank you guys for replying. You know, if you are watching, I will have more motivation to put in more energy to explain all the concepts. Okay, I'm so glad everyone is with me. Chalo guys. Now tell me, which of the following will qualify as a generally available information? Guys, and please don't refer my notes while answering my questions. It's a request. Yes, option B is the correct answer. Perfect, guys. Other information are UPSI. Next is a person not connected to the company trades using confidential merger news received from a friend. He will be called as not an insider, insider only if employee, insider due to access to UPSI, or D, insider only after investigation. What is the answer to the second question? Suman, thanks a lot for your effort. Guys, I don't know how to reply to this comment. I will think and answer, okay? Welcome, guys. So now quickly answer me the question. A person not connected. Sujit, sir, thank you. Sir, I am waiting for your marathons. Means a lot, Sujit. Yes, guys. Second answer is C. Insider, because he has got access to UPSI. Next is, which of the following is not a valid defense for trading while in possession of UPSI? Proving lack of knowledge, trading under approved trading plan, acting on public information, or D, being a non-connected person. Which of the following is not a valid defense? Valid defense. Answer is, guys, D, perfect. Being a non-connected person. Next is, people, a trading plan is disclosed on 1st March. Earliest date for trading is, people, tell me the answer. Fourth question, 120 days from 1st March. Will be, people, the answer is 30th June. Easy, no, guys? So these type of MCQs will come in your exam. You don't have to worry at all. Next is, now you know the answer. The moment I use the word structured digital database, you tell me what is the time period. Time period for company going under investigation, also tell me. Companies not going under investigation, also tell me. Fifth question. Answer is, fifth answer. Guys, tell me the answer to the fifth question. Guys, so listen. Listen. You have to tell me the question number. Now, beside the question number, tell me the answer. You are giving me A, B, C, D. I don't know for which question are you answering me. Fifth question answer, people, tell me. Answer is C. Amazing, guys. But if the company is going under investigation, it will be more than 8 years. Okay, sir. Next is, continual disclosure is required when trading value exceeds 10 lakh rupees. Now, within 1 month, within 1 quarter, within 1 year, or within 1 calendar year. Now, people, tell me the answer to the sixth question. Quickly tell me the answer to the sixth question, guys. Yes, if investigation more than 8 years. Sixth question answer, guys. If trading value exceeds 10 lakh rupees in a quarter, in a financial year, in 1 month, or in a 1 day, tell me what is the answer. Sixth answer is B. Perfect. Next is seventh. Time limit for disclosure after crossing 10 lakh threshold is 1 day, 2 trading days, 3 trading days, or 7 trading days. Okay, what is the time limit, guys? Once I have crossed 10 lakh rupees in a quarter, I have either bought shares, I have either sold shares. In that case, within what time period I have to disclose? It is, answers, people, 2 trading days. You have to learn the number. Okay, people, don't worry. You have to learn the numbers. Okay, it's very easy. Even if you just study it for 2 to 3 times, people, that's it. You will know. Just make a note in which case 120 days is used, 7 trading days is used, 2 days are used, and then you'll be sorted. You have to first separate it individually and then read it every single day in the morning. You'll be sorted. Okay? Chalo, people. Next is, who is primarily responsible for ensuring internal controls to prevent inside trading? Is it compliance officer? Is it board of directors? Is it CEO? Or is it audit committee? What is the answer to the 8th question, guys? What is the answer to the 8th question? Everyone. No, Belgaum, no. I told you who is responsible to formulate and implement laws. MD or CEO? Over here, people, CEO will come into the picture. Compliance officer will check whether rules formulated by CEO or MD has been followed or not. Compliance officer's job is only to check whether rules have been followed or not. But who is going to ensure that internal controls are in place in the company? Who is responsible for ensuring internal controls? It will be MD and CEO. But who is going to ensure that those laws are followed properly or not? Compliance officer. Compliance officer will not make the laws. MD or CEO will make the rules. Okay, guys? Are you able to understand the difference? I know that there's a little difference in the wording, but this is the logic. MD, CEO will make the rules. Compliance officer will check whether rules have been followed or not. Okay. 9th question. Which authority reviews effectiveness of insider trading's internal controls? Is it SEBI? Is it compliance officer? Is it audit committee? Or is it stock exchange? The answer is, people, over here. The answer is, anybody wants to try? Anybody wants to try, guys? The answer is audit committee. Will check whether the internal control system is in place or not. If it is not proper, audit committee will suggest improvements to make it more strong. Next is, people, pre-clearance trade must be executed within how many days? Tell me, people, quickly. Is it 5 days? Is it 7 days? Is it 10 days? Or is it 2 days? What is the answer, people? The answer is yes, Belgaum, amazing. Guys, it's a request. Please send me the question number. Along with the question number, send me the answers. Don't just send me the answers. How will I know which question did you answer? Okay? The answers, people, 10th answer is B, 7 trading days. Now, people, quickly will cover case study based question. Mr. A is a senior employee of XYZ Limited. On 1st April, he becomes aware that the company is planning a major acquisition, which is not yet publicly disclosed. On 5th April, he shares this information with his friend. I told you, no insider can communicate, procure, or give access to UPSI. This guy has violated the provisions. On 10th April, Mr. B purchases shares of XYZ Limited worth 12 lakh rupees. This guy has also violated. You cannot also purchase shares while you have access to UPSI. On 15th April, the company publicly announces the acquisition. Mr. A had already submitted a trading plan on 1st January, which was approved and disclosed on the same date. He executes a trade on 20th April as per the plan. Mr. B does not make any disclosure to the company. Violated the provisions. XYZ Limited maintains a digital database, but records are not fully updated. Now the question is, examine the legal validity of the above transactions. First, I told you, people, how are you going to start? The answer, Suman, don't worry, buddy. Now what you have to do is, Suman, you print my notes, you learn from my notes, and then again try to answer my question. Definitely, I'm sure that you will be able to answer all my questions. I know that questions were a little tricky, guys, but the only reason why the questions were tricky is only to check whether you understood the provisions or not. So don't worry if your answer is wrong. I'm there with you. If you have got any doubts, even after learning from my notes, you drop all your doubts in the comment section. I will make sure that all your doubts will be resolved in less than 3 hours. Okay, Suman, don't worry, I'm there with you. You will be sorted. Okay. Now, people, whenever you start any case study based question, I told you, you have to start with, as per the provisions of SEBI, prohibition of insider trading regulations dealing with UPSI restricted. You can also write over here 2015. Okay. As per the Companies Act 2013, in the same way, you can also write as per SEBI prohibition of insider trading regulations 2015 dealing with UPSI is completely restricted. Now you have to write the exact provisions. An insider includes any person having access to UPSI. Sharing UPSI is not allowed except it is for legitimate purpose. Trading while having UPSI is not allowed. Trading plan is not allowed after. Trading plan is allowed after 120 days after disclosure, public disclosure. Disclosure is required about 10 lakh in a quarter. Okay, sir. Now let's understand what happened in the case. Mr. A shared UPSI, which is not allowed. He violated. Mr. B traded. He also violated. Mr. B did not make disclosure to purchase 12 lakh rupees shares. Violated. Mr. A followed a trading plan after 1 day. So this part is valid of A. Remaining part is not valid. Company did not maintain a proper digital database. Hence, it's a non-compliance. So we are done with intro. We are done with provision. We are done with analysis. Now we have to write the conclusion. There is a violation of UPSI rules by A and B while the trading plan transaction is valid. Apart from that, other transactions are not valid. So this is how people, in the simplest way possible, you have to write down the case study based question. Intro, provision, exact provision, analysis, how are you going to apply the provision to the case, and then one line conclusion. Easy enough, people. Give me a quick thumbs up, guys, if you are with me. Now we are going to proceed with the direct question. Explain the concept and process of trading plan under insider trading regulation. Now you have to explain the trading plan. Again, as per the SEBI prohibition, a trading plan allows insiders to trade in a lawful and in a transparent manner. Intro is done, people. Now you have to write down the meaning of a trading plan. It's a pre-decided strategy made by an insider to buy or sell securities. The insider must submit the plan to the compliance officer for approval. After approval, the plan must be made publicly disclosed. You have to wait for 120 days. Compliance officer will have to inform the stock exchange. Once everything is done, then only you can execute the trading plan. Thus, a trading plan ensures that insiders can trade without misusing UPSI, maintaining transparency and compliance. People, easy now. So we are done with insider trading also. Shall we take a break of 5 minutes, guys? So before we dive on to the next chapter, we'll take a break of 5 minutes. We'll meet at 8:13 p.m. Break. If you want to have your dinner, guys, please have your dinner while watching the marathon lectures. Okay? For 9 days, you're going to have dinner with me. Cool, people? Chalo. So I will see you at 8:13 p.m. Link will be same, guys. Don't worry about the link. Same lecture. You have to just resume it. Yes, guys, how are you? Shall we start? Online students have dropped me a message. Sir, daily how many hours lecture? Belgum, my goal is to complete all the lectures every day for 3 hours. You're going to be with me from 6 p.m. to 9 p.m. But some days it will extend more than 9 p.m. Okay. Next is, sir, please upload your highlighted notes so we can check the MCQ answer. Suman, 1 second. Which one are you talking about, Suman? Are you talking about these notes or are you talking about the mind map, Suman? Which notes are you talking about? Let me know in the chat box. Chalo people. So, now we are going to move on to the last chapter of SEBI regulations, which students often find it very, very difficult. That is the takeover code. Don't worry guys, I am with you. After watching this lecture of takeover code, you will not have a single problem in any concept. This is going to be my promise. Okay? Chalo. Takeover code. First of all, what is the meaning of a takeover? A company, if it acquires another company, this is called as a takeover. An acquirer gains control over the target company. How can you gain control, sir? Control can be gained by doing two things. It could be either by purchasing the shares or by controlling the board of directors of the company. That means what, people? Even if I don't have any shares, even if I am not purchased any shares in the company, still, if the board of directors are accustomed to act as per my instructions, if these guys are listening to me, that means still I have got a control over that company. Control always does not mean that I have got voting rights, I've got shares, enough shares in the company. No. Control can also mean that the management is acting as per my instructions. This is called as control. Sir, thank you. The revision is awesome. Dash, welcome buddy. Means a lot. Sir, means notes with your marking. I think you are talking about the mind maps. You will receive all the mind maps, Suman. Okay? Chalo. So people, Tata Motors acquire Jaguar. That means an acquisition. Control has been gained. Next is, we'll go from the basic, guys. Okay? You might have a thought in mind that, sir, this is very easy. We don't want to understand this. We want to go towards the main topic. But people, first we're going to understand from the basic and then we'll touch the main topics. Otherwise, you will not be able to understand the main topic at all. Okay, people? Chalo. What is the meaning of substantial acquisition of shares? The moment acquirer buys shares or voting rights, 25% or more, he is not controlling. But now he has got a significant influence. He has got an impact in the company. This is called as, people, substantial acquisition of shares. There is a difference between control and influence. Control means whatever I say, this company will have to accept whatever I am saying. Influence means what, people? Whatever I say, they don't have to follow me, but I have got a certain impact in the decisions of the company. That is called as, people, substantial acquisition of shares. Okay. Walmart bought a stake in Flipkart. Major influence. Okay, sir. Next is, what is the meaning of acquirer? Acquirer means any person. It could be an individual, it could be a company, or it could be a group of companies, Adani Group, Ambani Group, who buy shares or gains control of the target company. And target companies, people, usually it's a listed company. Why? Because we are studying SEBI regulations. So it's usually a listed company. Okay, sir. Next is, control means what, people? The difference between control and substantial acquisition. Control means you have the power to appoint majority directors or you influence management or policy decisions. So this is called as, people, control. Example is Meta Platforms controls Instagram. That means they have got a decision making power in the Instagram. Okay, sir. Next is persons acting in concert. What is the meaning of persons acting in concert, guys? Persons or groups who work together to do what? To achieve a common goal. And the common goal is, people, it could be a control, it could also be an acquisition. Example is promoters of Reliance Industries are acting together. This is called as people, persons acting in concert. Persons or group who work together for a common objective. What is that common objective? Common objective is to gain control or to gain acquisition. Okay, sir. 1 second, guys. Let me check if people are watching or not. Yes. Okay. Now, sir, what is the meaning of target company? Target company is the company that is being acquired. In case of Tata and Jaguar, you tell me which one is the target company? Jaguar is the target company. Company being acquired whose shares are purchased. Usually it's a listed company because we are studying SEBI regulations. Okay, sir. Now let's come to the conceptual part. What are the types of takeover? Let's understand this using mind map. So, types of takeover. How many types of takeover are there, people? 1, 2, 3, 4, 5. 5 types of takeover are there. Number 1 is, people, friendly takeover. Means what? Target company and the board have consented that please acquire us. We have got no problem. Promoters of the target company voluntarily agree to sell and both parties are cooperative in the acquisition process. This is called as, people, friendly takeover. Flipkart acquired Myntra. Facebook acquired WhatsApp. This is called as friendly takeover. Next is hostile takeover. Over here, people, Facebook tried to acquire WhatsApp, but WhatsApp management told that no, we don't want to sell you this company. Elon Musk went to the founders of Twitter that we want to purchase this company. Twitter's management told no. Then Elon Musk, he approached the public shareholders, bypassing the management, and they purchased the shares of the public, thereby immediately gaining control over Twitter. Now this type of acquisition is called as, people, hostile takeover, where management is disapproving the acquisition, still you have acquired the company without their consent. Acquirer bypasses management, plus he directly approaches shareholders to buy enough shares to gain control despite opposition from the management. Next is, people, what is the meaning of horizontal takeover? Horizontal takeover is a takeover by companies who are in the same industry. This is called as horizontal takeover. Facebook acquiring WhatsApp is a horizontal takeover. Same industry to reduce competition or increase the market share. Next is, people, vertical takeover. Apple has acquired Beats Electronics. Now listen to me very, very carefully. If you are acquiring your supplier, if you are acquiring your customer or a distributor, this is called as, people, vertical takeover. You acquiring your supplier or you acquiring your customer or a distributor, this is called as, people, vertical takeover. Very easy. Next is, people, conglomerate takeover. Means what? Acquirer and the target company both belong to different industry. This is called as conglomerate takeover. Okay, sir. So 5 types of takeover we have understood. Number 1 is friendly. Number 2 is hostile. Number 3 is horizontal. Number 4 is vertical. And number 5 is, people, conglomerate takeover. Okay. Now, let's come over here. Types of disclosure. This is done. Now, types of disclosure. 3 types of disclosures are there. Very easy. Number 1 is, people, event-based disclosure. When will this happen? When the acquirer, promoter, persons acting in concert, when they buy, when they sell shares, when they pledge shares, during that period, people, they have to make a disclosure. Okay. Now, exception is banks holding shares as a security are not supposed to make a disclosure because bank's goal is not to acquire or gain control over this company. Okay. Next is, people, continual disclosure. What is the meaning of continual disclosure? Means what? Irrespective of whether you have purchased or not, you have to make a disclosure. You are the promoter over here. But if you are a non-promoter, you have to make disclosure only if your shareholding exceeds 25%. Otherwise, you don't have to make a disclosure. Every year on 31st March, two people have to make disclosure. Promoter, every year, irrespective of the transaction. Non-promoter, only if the value exceeds 25% within 7 days to stock exchange and the company. Very easy. Next is people, encumbrance based disclosure. I have taken a loan from the bank. In return, I have kept my shares as a security. This is called as encumbrance. Pledge or a lien. Promoter will make disclosure when he creates, he invokes or he releases pledge. In that case, within 7 days, promoter will have to make a disclosure. Okay, sir. Very easy. Now, people, let's come to the main part of this chapter, and that is open offer. First of all, tell me quickly, everyone, are you guys with me? Give me a thumbs up quickly so I know that you guys are watching. Quickly give me a thumbs up. Everyone, quickly give me thumbs up, guys. 7 days from 31st March. Yes, Suman, correct. 7 days from 31st March. Yes, sir, watching, present, sir. Okay, amazing. Chalo, guys, now we're going to talk about the most important part of this chapter where students often get confused. See. Two people are involved over here, acquirer and the target company. Okay, acquirer has purchased 10% shares, not a problem. Acquirer has purchased 24% shares, not a problem at all. Acquirer has purchased 24.99% shares, still not a problem at all. Acquirer purchases 26% shares. The moment he exceeds the 25% threshold, immediately acquirer has to make an open offer to acquire additional 26% shares of the company. Until and unless you are holding 24.99% shares, not a problem at all. But the moment you have crossed 25%, SEBI says, wait, now you have to make an open offer. Ask public that I am going to control over this company. Anyone who wants to exit this company can sell me their shares. That is called as open offer to acquire. How many shares, people? 26% of shares. Now, listen to me very, very carefully. Not necessary that all the shareholders will sell their shares, but you have to make an open offer to acquire 26% of shares of the company. Now, what is the meaning of open offer? One question will come to your mind. Open offer means giving public shareholders an opportunity to sell their shares. Suddenly, if Elon Musk acquires Reliance and you have invested your hard-earned money in Reliance, don't you think you have been cheated? You should be informed so that you will sell your shares if you don't believe in the management of Elon Musk. So that is why, people, SEBI says that the moment the acquirer touches 25% shares, immediately acquirer has to make an open offer to acquire additional 26% of shares. See, acquirer plus persons acting in concert, the moment they acquire 25% or more in the target company, they have to make a public announcement to offer to buy at least 26% shares of the target company. Easy now, people. Are you able to understand this point now? Okay. Now next is, now we know that when is open offer required? The moment acquirer touches 25% or more, he has to make an open offer to acquire additional 26% of shares. Now, people, next provision is requirement of open offer the moment you cross more than 5%. Sir, just now we have studied 25%. Now, why 5%? Now, this is for those people who are already holding 25% or more shares. You are done with your open offer, number one. Now, people, once you are controlling 25% shares, now the moment you acquire more than 5% in a financial year, if you acquire more than 5%, then immediately you have to make again an open offer to acquire at least 26% of shares of the target company. Why? Because gradually you are acquiring the people, not allowed. Public shareholders should not be surprised by the new management. That is why every single time you cross a threshold, they should be informed that this guy is going to gradually take over the control. Anyone who does not believe in the leadership of this guy can sell their shares to the acquirer. Easy now, guys. Give me a quick thumbs up, guys. Yes. Perfect. Aro Kulkarni is there. So, acquirer along with persons acting in concert who are already holding 25% or more shares, the moment they acquire more than 5% shares in a one financial year, immediately they have to make a public offer to acquire additional 26% of shares. Very easy, people. That's it. Chalo. Now, next topic is very, very interesting. So, we are done with open offer. Now, people, we are going to talk about additional rules. Very important. If I would be the examiner, I would put this question in your exam. Definitely. Let's understand this. People, tell me one thing. If a target company is a listed company and the acquirer has purchased 90% of shares of the target company, do you think it would make sense for a company to still be called as a listed company? No. Listed company means what? Public is participating actively. But if 90% shares are held by the promoters of the acquirer, then how do you think that public will have participation in the company? That is why SEBI says that if you are calling yourself a listed company, you have to make sure that 25% shares are held by the public. If at all you are crossing more than 75% shares, you have to release these shares back to the public. That is called as public float requirement. The objective is simple. If you are calling yourself a listed company, you have to make sure that public has got enough shares to participate in the important decisions. And that will only happen if public has got 25% voting power. Chalo. Now let's read this, people. Over here, one important topic is there. You will be amazed when you understand this topic. Public float requirement. Meaning, if an acquirer along with persons acting in concert, they have to ensure that public has got at least 25% of shares. If at all you have exceeded, you have to reverse back the transaction. How? Number one is very easy. You sell the existing shares randomly to the public. You sell existing shares random to the public so that you reach 75% threshold. Remaining 25% shares are held by the public. This is your option number one. Very easy. Divesting shares. Now next is, people, subscribing to new shares. That means what? Now you know that you don't want to sell the existing shares. But what you can do is you can issue new shares. And when you issue new shares, you can only purchase 75% shares. Remaining 25% shares will go back to the public. Second option is you issue new shares. Half will go to the public. Public shareholding will increase. And the half will remain with you. This is the second option. Number one option is very easy. Divesting access beyond 75%. Number two is you issue new shares and you subscribe very little shares so that public will get more shares. The third option is my favorite. Now listen to me very, very carefully. You can sell existing shares through offer for sale or through qualified institutional placement. Now listen to me very, very carefully whatever I am saying. Let's take an example of Microsoft. Bill Gates, this is Bill Gates, sorry. Bill Gates is the promoter. Melinda Gates is the persons acting in concert. Facebook is also persons acting in concert. So these three people are the promoter and the promoter group. Now, people like you and me are the retail people. Now, big wealthy Indians are also there. Big wealthy investors are also there. Warren Buffett, Steve Jobs, Mukesh Ambani is also there. Now, people, I also told you three types of investors. Number one is retail people. Number two is non-institutional investors, high net worth individuals. And number three is qualified institutional buyers. Very big players. Banks, insurance companies, pension funds. So now, listen to me carefully. Among QIBs, two people are there, SBI and LIC. The problem is, SBI is a troublemaker. SBI always causes issues. Whenever Microsoft wants to take any decisions, SBI always causes trouble. But LIC is a very good guy. He's a peacemaker. Whatever Microsoft says, LIC says, yes sir. Now people, the problem is, Microsoft wants to remove SBI. Microsoft wants to remove SBI from a shareholder. So what Microsoft will do is, Microsoft will purchase the shares of SBI. The moment Microsoft will purchase shares of SBI, they have exceeded 75% limit, yes or no. Now they have to release those shares back. So what Microsoft will do is, Microsoft will buy shares from SBI and sell these shares to LIC. Did you understand, people? Sir, if this 25% rule is not complied, what will happen? SEBI will penalize you. If you are calling yourself a listed company, you have to make sure that public has got 25% shares. So in exceptional situations, you have to do this. Number one is, you can divest excess shares. You can subscribe to new shares while issuing new shares. Next is, you can sell the existing shares. Over here, you don't want troublemakers in your company. So what you do is, you purchase shares of SBI. Now you have exceeded the 70% limit. Public shareholding has got reduced. Now what you do is, now you sell these shares back to LIC, and that is called as, people, qualified institutional placement. Okay people, so you should not get confused between this one and this one. This one is very easy. You sell shares randomly to the public. It could be retail people, it could be high net worth individuals, it could be QIBs. But over here, what you're doing is, you're buying from one QIB and you're selling this to the other QIB. Are you guys with me? Give me a quick thumbs up, guys. So let's read this. Public float requirement. They must maintain a public shareholding of 25%. Acquiring, if you acquire more shares, then you have to sell shares to public. It could be via offer for sale or qualified institutional placement. You're only giving it to selected people. Divesting excess shares to restore public shareholding, you're giving it to random public. And third is, you don't want to sell your shares, you are issuing new shares, and certain shares you are keeping with yourself, and the majority you are giving it to the public. Easy now, guys? Are you able to understand the logic behind why certain laws has been made? If you understand logic behind every single law, you will not get confused at all. Okay? Shalom, people. Now next topic is voluntary open offer. Let's come over here, people. Voluntary open offer. Now people, what is the meaning of voluntary open offer? Earlier we have understood, the moment acquirer crosses 25% threshold, SEBI mandatorily asks the acquirer that, buddy, you have to stop over here, you have to acquire additional 26% shares of the company. But over here, people, acquirer is voluntarily agreeing to purchase a lot of shares. He is not triggered by any SEBI laws. Let's understand this, people. When an acquirer chooses to buy more shares from the public, even without crossing any threshold, this is called as, people, voluntary open offer. Now, when does voluntary open offer occurs? When the acquirer sees a lot of potential in this company. No matter what, I want to acquire this company quickly. I don't want to follow creeping acquisition. Gradually, slowly, I don't want to acquire. Immediately, one shot, I want to acquire. This is called as, people, voluntary acquisition. Okay. Now, voluntary acquisition is, people, done by choice, where the acquirer, listen to me very, very carefully. This point is very, very important. Over here, acquirer is already holding 25% or more shares. Now he wants to acquire more shares to gain control. Three conditions. Number one is, it is done by choice. He should be holding at least 25% shares. And number three is, wants to increase further. This is called as, people, voluntary open offer. Now conditions. We know it is initiated at the choice of the acquirer. Now, let's come over here. Simple points. Open offer to acquire at least 10% of voting share capital. So what SEBI says is that now that you are making a voluntary open offer, you have to make sure that you are offering to acquire at least 10% of shares. You cannot acquire 3%, 4%, no. If you are making a voluntary open offer, you have to make sure that you are going to give an open offer to acquire at least 10% of shares. Next is, another condition is, I told you, acquirer to make a voluntary open offer, he has to make sure that he is holding at least 25% of share capital in the target company. Third condition is a pre-existing condition. 3 conditions. Number 1 is done at the choice of the acquirer. Number 2 is he must already holding 25% shares. Now that he is going to make the voluntary open offer, he has to make sure that he is going to make an open offer for at least 10% of shares. 20% shares is holding. Now he has to make an open offer to acquire at least 10% shares. It could be more, but at least 10% shares he has to make. Next is, people, this condition is little difficult. We'll come over here. Now that acquirer is making a voluntary open offer, SEBI says that you have to acquire at least 10% shares. So if SEBI is putting in so many rules and conditions, acquirer should also get a benefit. Acquirer can also say that I should receive minimum. I am willing to make at least 10% of voluntary open offer, but I should also get minimum 7%, 8% of the shares by the public shareholders. If this condition has been satisfied, then only I will proceed forward, otherwise I will not proceed forward. If SEBI says that I am making a voluntary open offer, if SEBI says that you have to make at least 10% of open offer, if so many rules and conditions has been imposed on the acquirer, acquirer also has a say on this matter. Acquirer can put a condition that I will make an open offer to acquire at least 10% of shares, but I shall also accept minimum XYZ amount of shares. Then only I will proceed forward with the open offer. Very easy now, people. Everyone give me a quick thumbs up, guys. Next. Now that the acquirer is acquiring shares, he has to acquire shares in one channel only. He cannot acquire shares from other channels. No. No backdoor acquisition should happen. If you are going to acquire, follow one route and you have to acquire from that route only, and that is the open offer process. Only in the open offer process you can acquire shares. You cannot use any other routes to acquire shares. Easy now, people? Chalo. Next is this condition. Very easy. Now that voluntary open offer has been completed, voluntary open offer is done. Now the acquirer cannot acquire additional shares for how long? For 6 months. After voluntary open offer, you cannot acquire additional shares for 6 months. Why? Because right now the market is very sensitive. If you acquire more shares, it's going to backfire on the market. So SEBI says stop, pause for a moment. You cannot acquire more shares, wait for 6 months. Now people, there are 2 exceptions to this case, where in these 2 situations you can still acquire more shares. Even if 6 months has not been completed, still you can acquire in these 2 situations. Number 1 situation is, people, if the acquirer is making another voluntary open offer, publicly is again making a voluntary open offer. Now the voluntary open offer is not secret, it is open, so it is allowed. Now there will not be any market fluctuations because the market is sensitive. No, because everything is going on openly, publicly. Or participate in a competing open offer, or participating in a competing open offer. What is the meaning of this? Now people, someone else is taking control over the company. Now you want to defend, you are allowed to defend. Example is Beats Electronics. Beats Electronics. Mark Zuckerberg, Elon, both have made a voluntary open offer. Voluntary open offer has been completed. Now these 2 guys are again making voluntary open offer. So if Mark Zuckerberg is making another voluntary open offer, Elon Musk can still make a voluntary open offer to compete with Mark Zuckerberg. So read this again. Acquirer, once voluntary open offer is done, you cannot acquire more shares for 6 months. But there are two exceptions to this case. Number one is you make another voluntary open offer, everything is open, public. Or number two is you participate in another competing open offer. You are allowed to defend yourself. That's it, people. Now next is, this condition is my favorite. Students often get confused in this condition. Must not have acquired shares in the preceding 52 weeks. That triggers a mandatory open offer. Now people listen to me very, very carefully. I told you, when does a voluntary open offer occurs? When the acquirer is already holding or crossed 25% shares. Now that you have crossed 25% shares, don't you think you should have completed the mandatory open offer process? Once you are done with that, then you are allowed to make a voluntary open offer. But this guy, if you are that acquirer who has secretly acquired 5%, 6%, 7%, and gradually you have crossed 25% limit without giving a mandatory open offer, and now you are saying that I want to give a voluntary open offer, not allowed. So in the last 52 weeks, if you have acquired shares anytime that required you to make a mandatory open offer and you have not done that, you cannot make a voluntary open offer. You cannot make a voluntary open offer. So people, are you guys with me? Are you able to understand everything what I am teaching you guys? Give me a quick thumbs up, everyone. Everyone, give me a quick thumbs up. We are understanding every single law using logic. Okay, people. So you don't face problem while learning the laws. Okay. So how many conditions we have studied till now? 1. An acquirer can withdraw. Okay, this is withdrawal. Okay, people. So let's come over here. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. 7 conditions we have understood. Very easy, no, people? Yes. Perfect. Now people are going to understand withdrawal of voluntary open offer. Now that you have made a voluntary open offer, now you want to withdraw that voluntary open offer. Let's see. You are allowed to withdraw only under specific conditions. Number one is SEBI permits you the withdrawal. SEBI says that it's okay, even if you withdraw, that's completely fine. Now the important question is, when will SEBI permit withdrawal? When the company has got bankrupt, when company has been closed down, when the management of the company has been convicted of fraud. In that case, you cannot complete the acquisition. Completely allowed. Number 2 is, people, stat approvals have been denied. RBI, SEBI or Insurance Regulatory Authority have denied you. Then people, next is acquirer has died. If the acquirer is an individual and that individual has died, in that case you are allowed not to complete the voluntary open offer. But this is allowed only in case the acquirer is an individual. If the acquirer is the company, you have to complete the open offer. Next is conditions stipulated in the agreement was not fulfilled. So people, you have made a voluntary open offer on a condition that if WhatsApp receives license for XYZ software, then only Facebook will complete this acquisition. Otherwise, Facebook will not complete the acquisition. WhatsApp did not receive the license, so Facebook is allowed to withdraw voluntary open offer. So the conditions based on which you have agreed to make a voluntary open offer, if those conditions have not been complied, you are allowed to back off. Very easy, people. So 4 conditions we have understood. SEBI, stat approvals have been denied. Acquirer has died. Condition stipulated has not been followed. Okay, sir. Now let's come to the next topic. Mode of, once again, withdrawal of open offer. Let's, okay. Public announcement of withdrawal. You have to make a public announcement within 2 working days of the occurrence of the event justifying the withdrawal. So the moment you have withdrawn, you have to make a public announcement. Then an announcement shall be published in the newspapers, intimated to all the authorities, SEBI, stock exchanges and registered office of the target company. Easy no people? Chalo. Now mode of payment to the shareholders. Payment can be made in cash, payment can be made in listed shares. Company can give listed shares as the payment to the shareholders of the target company. Next is company can also give listed secured debt instruments, bonds, debentures listed and rated at least investment grade by a SEBI approved credit rating agency. You cannot give them a ordinary debentures or bonds that will not be encashed. You have to give them very good bonds and debentures that has been rated at least investment grade. It should be purchased by somebody. Then only it makes sense, right? And last is you can also give convertible debt securities, people. Very easy. So 4 types of payment can be made to the shareholders. Number 1 is people cash. Number 2 is listed shares. Number 3 is listed secured debt instruments. And last is convertible debt securities. If you don't understand any concept, people, just let me know in the chat box. Okay? Chalo. Now next is escrow account. Now let's come over here. Escrow account. Now people, why is escrow account made? Let's come over here. Yes. So people, tell me one thing. Let's assume that you're going to buy a house. Okay. The moment you decide to buy a house, the builder will ask you to submit a token amount. Yes or no? Now token amount is a security, saying that first of all you are allowed to get the house. At the same time, builder will sometimes ask, in case the house is very premium house, no? Builder can ask you to deposit a certain amount of money in a bank account, so that we know that you can fulfill your open offer. We know that you have got enough money to complete this open offer. We want to know, no people. You cannot simply say that I want to acquire this company and then SEBI will say, yes, you can continue. No. SEBI will check, do you have enough money in your bank account or not? Are you willing to really, genuinely want to complete the open offer or not? Purpose is, acquirer cannot touch escrow funds until the takeover obligations are completed, to guarantee the performance of the acquirer, and next is to secure payment to the shareholders. If acquirer is a bankrupt guy, how is he going to complete the open offer? So to prove that he can complete the open offer, he has to submit an amount equal to the open offer to the escrow account. He has to deposit the money in the escrow account. Easy no people? Very easy. Chalo. Now the escrow account shall be opened at least 2 working days before the detailed public announcement. So 2 days before detailed public announcement, you have to open an escrow account. Now when will the escrow account be closed? When can you receive the money that you have deposited in the escrow account? Listen to me very, very careful. This is very interesting. 30 days after completion of payments and all regulatory compliances. So whatever rules and regulations we have understood, the moment you complete with the rules and regulations, 30 days have passed. After that only you can withdraw the money from the escrow account. Basically to guarantee the performance of the acquirer. Acquirer first of all cannot touch the escrow money until he completes all the rules and regulations of the takeover. Easy now people? Are you guys with me? Give me a quick thumbs up. Now, in what ways you can deposit money in the escrow account? You can deposit cash in a scheduled commercial bank. Scheduled commercial bank means that bank which is tightly regulated by RBI. You can also give a bank guarantee. You're not depositing money. But HDFC Bank is saying that if I don't pay you the money, HDFC Bank will pay you the money. Next is freely transferable securities, freely transferable shares. Are you guys with me? So 4 ways in which you can deposit money in the escrow account. Number 1 is cash, number 2 is bank guarantee, and number 3 is freely transferable securities, and number 4 is combination of bank guarantee and cash deposit. Very easy, no people? Chalo. See, Mukesh Ambani ask HDFC Bank, buddy, please give a bank guarantee saying that I will fulfill the obligation. If at all I don't fulfill the obligations, HDFC Bank will pay. Okay, sir. Now let's come to the next topic. Escrow account is done. Everyone, guys, in case you have got any doubt with respect to any topic, just make sure to drop all your doubts in the YouTube comment section. If you are watching this lecture live, you can ask me in the chat box. But in case you are watching these lectures after live has ended, please make sure to drop all your doubts in the chat box. Okay. Chalo people. Now 3 topics are remaining. Quickly, we'll complete that. So it's going to take half an hour more, people. So will you guys be with me? Give me a quick thumbs up, guys. Be with me, guys. Don't leave me alone. Chalo. First of all, give me a quick thumbs up. Who all is watching? Suman is watching. Deepak is watching. Hi Deepak, how are you? Jayanand is watching. Sujit is watching. Okay. Now people, what are the obligations of the target company? Now we know that acquirer has to open an escrow account. He has to deposit money. Now the important question is, what are the obligations of the target company? Number 1 is, people, he first of all has to conduct business in the ordinary course. He cannot make any major business activities. He cannot take any major business decisions that's going to impact the business. The same way he has to conduct the business as he was doing before the acquisition. The board of directors of the target company must ensure the business continues to operate in the same manner as it normally would. You cannot do buyback, you cannot issue dividend, you cannot acquire another company using the money. The moment acquirer has entered into an agreement, you have to give the company in the same way as it was before the acquisition. Number 2 is, people, prohibition of fixing record date for corporate actions. I told you, you cannot declare dividend, you cannot issue splitting of shares, you cannot issue bonus shares. Now let's read this. The target company cannot set any record date. What is the meaning of record date? Record date is that date where shareholders are identified. On that date, whoever are the shareholders, they will receive dividend. Record date is that date in which, on that date, whoever are the shareholders, they will receive dividend or the bonus shares. So target company cannot set any record date for corporate actions during the period starting from the 3rd working day before the tendering period until the expiry of the tendering period. Example is, if the tendering period if the tendering period 15th January, 5 January. Now this is the tendering period, 3 working days, 1, 2, 3. No record date shall be kept in this date, 2nd Jan to 5th Jan. You cannot set any record date. Why, people? Can you tell me? If you declare dividend, then the shareholders of the target company will get influenced. Then will they sell their shares to the acquirer? No. And that is why, people, to stop them from influencing the shareholders, SEBI says you can keep record date before these dates, but not before 3 days the tendering period. Very easy. Now, people, next is, if the acquirer is going to acquire the shares of target company has to submit the list of all the shareholders along with the details. Then only acquirer will know who are my shareholders, whom should I pay money. Next is prohibition on alienation of material assets. You cannot sell, you cannot lease any material assets. Okay, let's read this. During the offer period, the board of directors of the target company or subsidiary companies shall not, without prior approval of shareholders by a special resolution through postal ballot undertake certain actions. So you cannot alienate material assets. If at all you are alienating material assets, you have to take the approval of the shareholders via special resolution. I am talking about the target company. Understood, people? Shareholders are getting benefited. So if you are going to sell the material assets, if you're going to put the material assets on lease, shareholders will be underpaid. So you have to take the approval of the shareholders via special resolution. Okay. Same point repeated. You cannot alienate material assets. Easy now, people. So if an exam question is asked, what are the obligations of the target company? Would you be able to answer the question? So don't worry, we won't leave you. बहुत awesome जा रहा है, like a fast track classes. Thank you, Varshil, means a lot. Sir, maybe आपको देख रहा हूँ. Yes, Suman, you want break? No problem, guys. We'll take a break of 5 minutes. But please make sure that you come back after the break. Okay, guys? Chalo. We'll take a break of 5 minutes. 2 topics are remaining, and then we'll start with MCQ, then case study based question, and then we are done with SEBI regulations. Easily you can score 10 marks. Easily. So 9 p.m. we'll take break till 9:05 p.m. Okay, guys? No problem. Break. Hey Siri, alarm at 9:05 p.m. Yes, Varshil, companies at in depth. I will get it done. Okay, don't worry. Yes, guys, are you with me? Give me a quick thumbs up, guys. Sir, we are with you. No, no, sir, आप हमारे लिए कर रहे हैं इतना. Okay, thank you, guys. Thank you so much for the love. Chalo, guys. Quickly, we'll complete the two topics. Okay? Chalo. Now we know the obligations of target company. In exam, if question is asked, you should be able to answer all those questions. Now next is obligations of the acquirer. Now what is the role of the acquirer? Simple, people. First of all, he should have money to fulfill his obligations. Number two, he has to implement the open offer. Number three, he also cannot alienate the material assets of the target company. Acquirer, Facebook, cannot alienate the material assets of WhatsApp. The acquirer cannot alienate any material assets of the target company during the offer period unless two exceptions are there. You should have disclosed in the published statement upfront that yes, I want to acquire this company, but while acquiring, I am going to sell this asset. If you're okay, thumbs up. If not, I will not proceed forward. Everyone said okay, that means acquirer can sell material assets, or it has been approved by the shareholders via special resolution. Next is, people, restriction on selling shares. Acquirer is acquiring shares. If that same acquirer sells the shares of the target company, don't you think it's going to send mixed signals to the shareholders? It will unnecessarily create panic in the company. Not allowed. If you are acquiring shares, you cannot sell those shares. Very easy. The last is, people, it is a job of the acquirer and everyone acting together with the acquirer to complete the obligations of the acquisition. Easy now, people. Everyone, are you with me? Give me a quick thumbs up, guys. 5 rules we have understood with respect to obligations of the acquirer. Number 1 is he should have enough money. Number 2, he should implement the open offer. Number 3, cannot alienate material assets. 2 exceptions. Disclose in the open offer upfront. Number 2, obtain special resolution by shareholders. Next is you cannot sell the shares. And last is it's the job of you as well as the persons acting in concert to fulfill the obligations of the open offer. That's it, people. Now last topic is remaining. Over here you will get confused. This is that topic which students often find very difficult. Just be with me for this topic, people, and then it's going to be very easy. This last topic will be confusing, will be very tricky for you. Okay, don't worry. Now, people, we have understood how does the acquisition happens. We know what all rules, regulations have to be followed by the acquirer. But there are certain situations where the acquirer does not have to make an open offer. There are certain situations where the acquirer does not have to make an open offer. Now, what are those situations? There are 6 situations. Number 1 is, people, acquisition in the ordinary course of business by an underwriter. I told you what is the meaning of underwriter. Underwriter job is to make sure that remaining shares, leftover shares, has been purchased by the company. Okay, if the IPO is not fully subscribed, underwriter buys the remaining shares. Yes or no, people? So if the underwriter is buying the remaining shares, he should not make an open offer. Open offer is not required. Jayanand, just be with me, guy, buddy. Just be with me for 5 minutes. That's it. In 5 minutes, we'll be done. Okay, Jayanand? So, an underwriter who is fulfilling his obligations to purchase the leftover shares, he is not supposed to make an open offer. Okay, sir. Next is stockbroker registered with SEBI acquiring shares on a behalf of a client. Now see, let's say Mukesh Ambani has instructed Zerodha to acquire shares of Adani. Zerodha has acquired shares of Adani. Mukesh Ambani did not pay money to Zerodha. Now Zerodha is holding those shares. He is waiting for Mukesh Ambani to pay money. So if Zerodha is holding those shares, then Zerodha is not supposed to make an open offer. Client does not pay dues. broker sells it or keeps shares, he is not supposed to make an open offer. He is only supposed to recover the money. Then people, third is merchant banker registered with SEBI or a nominated investor with market making. What is the meaning of market making, people? I have got my shares listed, but nobody is buying my shares. Nobody is selling my shares. So merchant banker will come in between. He will buy shares and then he will sell these shares at a very low price. He will buy shares at a very high price, sell these shares at a very low price. Continuously will buy, sell, buy, sell, buy, sell, so that liquidity is maintained. So people, if merchant banker is acting like a market maker, he is not supposed to make an open offer. Then people, fourth is acquisition pursuant to a safety net scheme. So people, there is one situation or a concept wherein the company that is going for an IPO, they promise to all the subscribers saying that you purchase our shares, but don't be scared if price goes down. If at all price goes down, no, don't worry. We will purchase these shares at a very high price. So you don't have to be worried about price going down. This is called as safety net scheme. So if the acquirer is acquiring shares pursuant to a safety net scheme, he is not required to make an open offer. Then people, merchant banker acting as a stabilizing agent. Now what is the meaning of stabilizing agent, people? Company is afraid that the price will go very down. Company does not want the price to fall down. So company will appoint a merchant banker that you will take care from price going downwards. The moment price goes down, it is your job to purchase more shares, to create demand, to increase the price back. That is called as, people, stabilizing agent. That is called as stabilizing agent. Okay. Next is acquisition pursuant to a statutory or court approved schemes. Disinvestment. Government has sold their shares to private company, not required to make an open offer. Number 2, reconstruction, merger, amalgamation. Company A is merging into company B, not required because court NCLT has approved it. Then third is enforcement of security. Company has taken a loan from the bank. In return, company has given securities. Company did not pay money to the bank. Bank has sold their shares. Bank is not supposed to make an open offer. Then people, acquisition of shares in person to delisting of shares. Company does not want the shares to be listed anymore. Now they are acquiring all the listed shares so that once they acquire, they will delist it. So in that case, company is not supposed to make an open offer. And last is company is cancelling shares, company is forfeiting shares. In that case also, company is not supposed to make an open offer. We are done with the takeover code. Okay. Now quickly we'll go to the MCQ. An acquirer, people, now quickly answer me the questions. Quickly. Okay. An acquirer with 24% shareholding acquires 2 more percentage of shares. What is the consequence? He has to make an open offer. Next is, after holding 30% shares, an acquirer purchases additional 4% in a financial year. What happens? No open offer is triggered. The moment he acquires more than 5%, open offer will be triggered. If additional acquisition exceeds 5% after crossing 25%, open offer must be made to acquire additional 26% shares. Next is which, yes, everyone is with me, thank God. Okay, which of the following persons is not required to make encumbrance disclosure? Promoter pledging shares, promoter releasing pledge, promoter invoking pledge. This guy is not supposed to make a disclosure. An escrow account must be opened at least 2 working days. Tendering period is open. In open offer remains open for at least, let's say it is open for 10 working days. 3 to 10 period, people, remember, 3 to 10 period. Easy, no? Next is, which of the following is a valid mode of payment in open offer? Unlisted, cash, unsecured, promoter guarantees. Tell me the answer to the 7th question, people, as well as 8th question also tell me. Quickly, guys, tell me the answer to 7th question. Which of the following is a valid mode of payment in open offer? People over here, unlisted shares, cash. People, let's cancel this question, okay? This question is not clear. Cancel this question. Let's come to 8th question. Independent directors must give recommendation before public announcement, before draft letter submission, at least 2 working days before tendering period. Last is after completion of offer. Over here the answer is, people, at least 2 working days before tendering period, an independent director must give a recommendation. Can you tell me why? So that everybody will know that if independent director has given a recommendation, that means what? This company is genuinely worth going for. Because director is independent, he will not act in a biased manner. Next is, during open offer period, target company cannot continue business, cannot declare dividends, alienate material assets without approval, provide shareholders list. The answer is C. Now you will get confused, sir. Just now we have studied that target company cannot declare dividend. They can declare dividend, but not before 3 working days before tendering period. Easy now, guys. Everyone. Amazing. Last question. Which acquisition is exempt from open offer requirement? Acquisition crossing 25%, acquisition under court approved merger through open market, promoter group. The answer is court approved merger. Okay, so people, we have, what we will do is, we'll only discuss case study based question. Now you know how to write direct question answer. Is that okay, people? Will that be fine if I only cover case study based question? Because in direct question, very easy. Whatever we have studied, same content is there. What you have to do is, you have to write the intro, you have to write the conclusion. That's it. So now let's read this. Alpha Limited is a listed company. Mr. Z, along with persons acting in concert, already holds 24% shares. Already he is holding 24% shares. Note it down. On 1st June, they acquired 2% shares through market purchase. They should have made an open offer to acquire additional 26% shares. On 10th August, they acquire another 4% shares. During the same year, they also pledge part of their shares to a bank. Further, before completing the first acquisition, no public announcement has been made. An open offer of 20% was later announced. First of all, tell me, are you supposed to make an open offer of 20% or 26%? Escrow account was opened after DPA, wherein you have to make an escrow account before DPA. During the offer period, the target company entered into an agreement to sell a major asset without shareholders' approval. Again, not allowed. Clear violation. Now, how are you going to supposed to write the answer? First of all, always start with, as per SEBI, substantial acquisition of shares and takeover, Regulation 2011, takeover and open offer rules must be strictly followed. Provisions. Crossing 25% requires open offer to acquire minimum 26% shares. Public announcement must be made before acquisition. Escrow must be opened before DPA. Promoters must disclose pledge, which they have not. Target company cannot sell material assets without approval. Now this is the provision. Now you have to write analysis. Holding increased from 24% to 26%. So open offer is required, which they have not. No public announcement before acquisition, so violation. Open offer 20% is incorrect. Escrow opened late, so violation. Pledge requires a disclosure. Sale of asset without approval is not allowed. And last is, these are violations of open offer, escrow and target company rules. So this is how, sir, 5% threshold is includes 2 plus 4%. Okay. See, He was holding 24%. He acquired 2% shares. He should have made a open offer to acquire additional 26% shares. He did not. Then on 10th August, he acquired another 4% shares. Clear violation. Okay? Clear violation. Suman, once you cross 25% threshold, after that, 5% will be applicable. Understood? The moment you cross 25%, then only 5% threshold will be applicable. Easy no guys? Everybody with me? So we are done with SEBI regulations. How was the marathon guys? Let me know in the chat box. So your approach is to be professional. Thank you, Jayanand. Thank you so much. Guys, it means a lot that you have stayed with me for so long. It's been 3.5 hours, guys. 3.5 hours. Okay, guys. Yes, thank you so much for watching. So, we will resume this tomorrow with the same energy and enthusiasm. We are going to resume with same energy and enthusiasm till 9 days. Okay, guys. 9 days you be with me and you just notice how beautifully you score in your CMA final law exam. Nobody can stop you from scoring an exemption in CMA final law. Okay guys, so let's end the session over here. Thank you so much for watching. I will see you in the next one. Take care, eat well, sleep well, study well. Bye bye. Sir, आपका consistency next level है sir. Thank you Varshil. Thank you so much guys. It means a lot. Which topic for tomorrow? Insolvency Bankruptcy Code 2016. Not only tomorrow, we'll join live for 9 days. Thank you so much, guys. Chalo, guys. Let's end this lecture. I will have my dinner. And tomorrow we'll see. Bye-bye. Yes, Bama, Amit, you will receive all the notes. Okay, guys? If at all possible, can you wait till the math on HS gets over? I will send you all the PDF notes in one PDF document. Is that okay, guys? You will receive all my mind maps. Everything will be sorted. Cool, people? Yes, yes, yes. Done, done, done. Chalo, guys. I will end this lecture. You go and take rest. Okay, guys? Bye-bye.